How are you doing today? Good. Beautiful day in Melbourne. Where else would you rather be on a Sunday? In Melbourne. So I know you've been learning a lot. Last night you would have heard from, obviously Baxter finished answering some questions for you on the share renting. And then some of you around when Stephen went through the land strategy as well. Who liked the land strategy? For some of you, that'd be the first time you've seen that. If you want to take advantage of that, you'll need to be in a hurry. We've done a lot to try and negotiate more land, but that project's pretty much done. So, and it's hard. Sometimes you like to teach a strategy so you can do it yourself, but that's one of those strategies that's very hard to go out and do it yourself. So it's more like you need it done for you. So it's not possible to have enough of that for every 21st century member. So we do our best, but that's pretty much, there's not a lot left of that. But for those who have been involved or getting involved, it's certainly quite exciting. Today you would obviously learn from Andrew again, Baxter. Andrew runs the team that looks after, with Halifax and 21st Century Broking. They'll be there as a resource for you guys. And also he has a multitude of strategies. And many members have done very well with a lot of Andrew's strategies, etc. So for some of you, that will be something you want to focus on. This session, what I'm going to talk about is I'm going to give you a bit of a global economic update. I started on that yesterday, but I want to go into a little bit more detail. And also I'm going to talk to you about the US property market, what's happened there in the credit crisis, where it's at now, where I see it going, and how that can fit in as your overall investment strategy and why I'm bullish on it, why I'm excited about it. At this point in time, we do have an opportunity to take advantage of that. It won't be that good forever. With very rare, very unique opportunity that's happened. I'll talk to you why and explain how it happened, because I think that's important, getting an understanding of what's likely to happen in the future. As we talked about yesterday, no one has a crystal ball. No one knows exactly what's going to happen. But I talked to you yesterday also and said, John Paulson, as an example, those of you who don't know John Paulson, he bet that the US property market would crash, one of the few people that saw it coming, and he made billions of dollars. You can actually buy a book, it's in the bookstores, about how he made something like $14 billion from betting that the property market would crash. He's come out recently and said in the US, while I was there a couple of weeks ago, that if people aren't buying US houses, they are crazy, because of the opportunity that exists. Richard Branson, so I say Warren Buffett. Is Warren Buffett investing in US real estate right now? The answer is yes. He is. He's a contrarian investor. And what a contrarian investor is doing the opposite of what most people are doing. Us as Australians, we love property. Is that true? Who would agree that Australians love property? We have a love affair with property more so than perhaps any other country on the planet. And I've always been bullish about the Australian property market. And we talked about yesterday how I think in the last 10, 20, 30 years it's done very well for us. I think there's going to be a slowdown in the next 1 or 2 years. Will probably be not ideal, not great. You're going to have to work harder to find the better deals and make more money. But for negative gearing benefits, it's still fantastic, especially if you don't have a property. I think you should still at least have 1 or 2. But I wouldn't be expecting the rampant growth in the Australian property market in the next 10 years that we've seen in the past. I would say more stable growth is about all we're going to get. So because of that, for me as an investor, because I've been investing in Australian real estate, for probably 12, 13 years, what I look at and say is I want to look at other areas as an investor that I can get a higher return. Does it make sense? And that's when we start looking at. That's when we talked about the land strategy. We looked at a little bit more sophisticated strategies that generally aren't available to retail investors. You are a retail investor. Does that make sense? You're becoming an investor if you're not already, and you're classified as a retail investor. Then there's institutional investors that go in and buy investments on bulk and effectively getting them at wholesale rates. But as an individual, you can't necessarily do that. But as a collective group, as 21st century members, we can become wholesale investors. Why? Because we can negotiate and leverage through the bulk buying power that we have as a group to be able to get access to deals that normally you wouldn't be able to get just on your own, because you simply don't have the buying power to do it. Does it make sense? So that does give us some extra benefits that normal retail investors won't get access to. Plus also because you guys are being educated, it means, when I talked about 2 days ago, I said, remember, the less education you have financially, the more money you need in order to retire. That's why most people think you need millions of dollars in lotto, because all you're going to know what to do is put it in the bank or get some money on your managed super fund, etc. You're not going to know what to do, so you're going to get a low return, so you need a lot of money. But as your education increases by being financially educated, you could draw a graph. Well, let's draw it for you. We would see this. You need a lot of money, okay? But if you draw a graph of this as your financial education, most people are financially illiterate. True? They have no financial literacy. But as your level of financial education increases, okay, you go from needing a lot of money to a Richard Branson who can do deals and make money out of thin air, or a Nathan Tinkler, etc. So the amount of money, as your education increases, the amount of money you need comes down to effectively zero in some cases, or certainly low amounts of money. Where up here it might be, might need $2 million in lotto to make any decent retirement income. Does it make sense? So you can see the power of knowledge is what it means is that you can actually get to your goal faster because you don't need as much capital to achieve it. So somewhere in here you're getting closer to it. It doesn't mean you'll always get to be able to do deals where there's no money down, but in the home study we do talk about no money down deals, etc. And I've done a lot of no money down deals. I'm doing one now. Rather than me put $15 million into a particular deal, I'm negotiating and do it for 10% or less. Does it make sense? Rather than have to tie up $15 million in cash, which would increase my risk. If I can get that for only 10%, or I'm hoping to work on it, even that 10% can be staggered, okay, so I'm not taking the risk on that. Make sense? Nathan Tinkler, to get that $442 million in his first deal, he outlaid how much? $1 million non-refundable deposit. That's all he could scrape together, selling his house, business, getting friends to help, to buy a $30 million asset, which ended up turning into $442 million for him. Does that make sense? Who would scrape together $1 million if you could to get $442 million? See, once you have the certainty and know what's possible, you'll do whatever it takes. Okay, so it's important as we develop our education. So one of the reasons why over the years at 21st Century we'll continue to introduce new strategies as the world changes, as the market changes, so you always have the leading edge strategies available to you as part of the buffet or smorgasbord for you to choose what's going to get you to A to B as fast as you possibly can. It doesn't mean you'll do all the strategies, but you can do more than one. Is that true? You don't have to just do one, you can do multiple ones. So in the property market now, I'm happy to invest in the US market. Why? Because I've done it, educated myself. I've been to the US a lot as well. I've looked at houses. I've done the due diligence. And as a result of that, my initial skepticism or fear or misperceptions have been overcome. And as a result of that, I'm now naturally driven to be excited about that marketplace and see opportunities. Does it make sense? Just like years ago, I didn't know anything about the property market until my mentor told me about it in Australia. And I had misperceptions. Once he reframed me and helped me understand even negative gearing, even if you have to put in $300 a month, the growth on that property, it's like having a magical bank account. All of a sudden, I was motivated. Making sense? Then with the stock market, I used to be skeptical of the stock market. And one of my mentors talked about the concept of covered calls, which I termed later share renting. And I looked at it treated it, compared it to a traditional business. That's we looked at the example yesterday. Compared to most traditional businesses, who would like a share renting business any day? It's so much simpler, less risk, easier to manage, and it's more realistic. It's there come tomorrow. You can enter into that business. Okay? So then I become excited. US property the same. So what's going to happen for some of you, this may end up becoming another vehicle for you. Now, if we get right to the bottom line as I go through this, the opportunity that exists in America right now is when you hear once-in-a-lifetime opportunity, you hear that, it's a cliche, but we're certainly talking a once-in-a-100-year opportunity, probably certainly once in our lifetime. I would not expect to say, you know what, I might just wait for the next opportunity for the US market for this to happen. We'll be dead before that happens. Does it make sense? This is your shot, if it's for you. Okay, so I'm excited because when you see sort of the prices of properties the rentals that are possible, what would take millions of dollars in Australian real estate to achieve a retirement position? We're talking Australians in the US market right now could achieve a retirement position for a fraction of what they can do in Australia. And when we start to extrapolate some of the figures, there would be people in this room right now that have access to enough equity and capital that could retire simply right now from the US market. Who would like to be in that situation, by the way? Okay, that is pretty exciting. Some of you will find you're not that far away to getting that position. So what we're talking about is, I guess, who likes Monopoly? Who's played Monopoly? okay? When you're over there or get to see it, or what some of the things we're doing, it's seriously like playing real-life Monopoly. That's what it's like. It's pretty cool, where you can pick up houses for ridiculous prices. Tonight, you're going to be playing a game. It's not Monopoly. It's a different game, the investing game. But you certainly stick around for that tonight. Your chance to win up to $5,000 in cash. But that's going to teach you a lot more about what we're looking at. So let's look at the US market, and let me share with you, first of all, what's caused it to happen. A lot of people talk about the credit crisis and what went on with the credit crisis. Well, let's look at what actually caused all that to happen, okay? The US credit crisis, actually, no one really, well, some people saw it coming, but a lot of people didn't see it coming. The reality was this. Ironically, there's a few different causes for it. Ironically, part of it was caused by people had the intention of charitable intention. When Bill Clinton was still in power in the US, he passed a law, he was pressured to pass the law, it wasn't his idea, but before he finished his presidency, he passed a law because there was a lot of push in the US to say it isn't fair that only the middle class and wealthy can have a house. What about the poor people? They deserve to own their own house too. In theory, that sounds great, doesn't it? Sounds great. So they passed a law that made a requirement that banks and lenders had to lend X amount of percentage of money to poor people. Making sense? And this was not the only reason, but one of the reasons that started what we call easy credit or easy lending, which we all know now was the cause, or one of the causes of the property crash. So the challenge is this. Let's think about in the Australian market. If they passed a law tomorrow that said banks had to loan X amount of billions to people that can't currently afford a house. So all those people that would like a house that are renting but can't afford one can now get 100% finance or 105% finance. Just sign on a dotted line. Done. What would happen to Australian property prices in the next few years if that happened right now? Would they crash or go up? They would go up massively. Why? Because all of a sudden there's all this extra demand of people that can't afford to buy a house are now going to go to auctions, are going to be bidding, and there's all this demand and pushes prices up. And that's what would happen. And that's what happened in the US to an absurd level. It wasn't just the law passed for poor people to get loans, but they increased easy credit. Now, I believe they did it deliberately, and the government, the Bush administration, turned a blind eye to it. Why? Because remember, it all started back September 11th. We all know what happened that day, 2001, and they were afraid the economy would go into a tailspin because of the terrorist strike. And it did. The economy and the stock market crashed, even though it rebounded back within 3 months. So one of the biggest industries in any economy is what industry? Tell me. Housing and construction. Housing and construction. So even in Australia, we're so dependent on construction. One of the reasons why, even though we've got a great economy, but it's still sluggish in a lot of areas, is because the construction industry is restricted. You know, look at Gold Coast as a city which is heavily used to construction. It's struggling as an economy because it was a property-type city. Most of the companies there are property-type cities, and no one's buying property in the Gold Coast. There's no more towers going up once they finish the ones there now. Okay, you won't see any more cranes in the Gold Coast for a long time. And that's a reflection of the state of the market there, okay? Because construction, it employs a lot of people. So as a result of that, what happened is easy credit is a great way to keep the construction industry, houses being built, and keep the economy ticking over nicely. And you can push the problem of a potential recession into the future. Just keep pushing it into the future, and hopefully it doesn't happen. Hopefully by then we'll figure it out, or something miraculous will happen, it won't occur. But it's not really dealing with the problem, is it? It's like putting steroids into a system that's already starting to creak because of high debt levels. And as a result of that, the other reason what the banks started to do easy credit was because of this. What banks would do? Who's heard of a bank called Lehman Brothers? Heard of Lehman Brothers? Remember when Lehman Brothers went under? That's when the real crisis hit, in the credit crisis. You know, I think it was 2007, 2008, whenever that was. And when Lehman Brothers went under, people really freaked out. The stock market had already been crashing before that, but when that happened, people went total panic. Okay? Total panic. So as a result of that, it become a major challenge because people don't understand that the world's financial system, particularly the US, was within hours of completely collapsing. The world almost went into a meltdown. They had to have urgent meetings and bank bailouts, and they were freaking out. And it could have been total disaster. Perhaps a lot of people don't appreciate that. Sitting at home watching TV, don't realise our whole financial system nearly caved under. It would have been horrendous, possible depression. That's what was on the cards. So they had to do everything to save that. But how the hell did Lehman Brothers, a 128-year-old bank, go under? Well, I can tell you why. Because what they started to do was this. They would get very clever. See, banks in Australia don't want to do too much lending, easy lending, because if you sign on a piece of paper and you're poor and you buy a house with the finance you can't afford to repay, that's going to hurt the banks. But what the banks were then doing over there is they were packaging mortgages up and then they were reselling them. So Lehman Brothers wasn't bothered about loaning money because they would just package the mortgages up and sell them as, jot this down, mortgage-backed securities. If you're an investor overseas in particular, if you're going to invest in a fund that's offering a good percentage interest and it's mortgage-backed, that sounds like, it's safe because it's backed by mortgages. No one actually ever checked the quality of the mortgages. There was people in San Francisco, as an example, many cities, there was people on the streets being signed up by dodgy finance brokers, sign here, given a brand new house. People that had no job, no income, unfortunately no idea, no ability to repay. Do you have to be an Einstein to figure out at some point in the future when these people cannot pay their loans that it's going to hit the fan? True? However, the banks, the safety mechanisms weren't there because they were taking these mortgages, repackaging them as investor funds, mortgage-backed securities, and then selling them to the world. So let's say, what banks like Lehman Brothers would do, they were all into it, but some bigger than others. It was easy money. They would actually then go and buy large broking firms and large real estate firms so they could control the whole channel, and they had lax lending, go out and write as many loans. If you were a finance broker back before 2008 in the United States, you were making a killing. You were making a killing. It was easy money. Okay, a bit like it, even better than what it was. Mortgage brokers in Australia used to make a lot of money, but not to that extent. Imagine if everyone can now get a loan as a mortgage broker, how much money would you make? Like, just sign here. Everyone wants the magic bank account. Just sign here, and you make the trial commissions. You would be rich instantly, and that's what was happening. Okay, so as a result of that, all these people were pouring into the market to buy property. Lehman Brothers was then saying buying $10 billion for the month of mortgages, which their companies were writing. They would then sell them. What eventually ended up happening, though, is foreign investors that were buying these funds started to get a little bit nervous. The ratings were dropping, and they were starting to get worried, so they stopped buying them. So more companies like Lehman Brothers had all these massive pools of mortgages, billions and billions of dollars, and that they outlaid the money for to buy them, repackage them, and sell them. But they go to sell them, there's no market there. And then all of a sudden they're stuck, burning cash. And they've got a Trojan horse sitting there that's going to destroy the company. Okay? Then the other banks get aware of this, and the other banks go, Lehman Brothers could be in trouble. Let's pull their line of credits, because banks loan money to each other, you realise. They have lines of credits with each other. So then they go, let's pull the line of credit just in case we don't get our money. Now a small problem becomes a bigger problem. All of a sudden, Lehman Brothers is losing all its lines of credits, running out of cash, and if it can't offload these mortgage-backed investments, it's going to go under, and it can't offload them. And as a result, it went under, and the financial world seriously panicked, because before that, Bear Stearns almost went under. They were coming in. The Reserve Bank was saying to some of the banks, Watchover was one bank, the directors on the board of directors of Watchover said, we weren't even given the control. We control this company. They come in and took the company office and said, you are now being sold, whether you like it or not. They basically took over. Bear Stearns was sold, I think, for like $2 a share or something. Okay, there was an uproar about it, but there was a crisis. Yeah, and it was all like this stuff was going on because big banks see this as an opportunity. What happened in the Great Depression, I understand that, there was a liquidity crisis. And the big banks got massive power because they were able to buy up all the collapsing cheaper banks, and they could control the money and become very rich. Okay? What they tried to do this time was stop the liquidity crisis, pump a heap of money into the system, and that's why US dollar is crashing, because of the inflation it's causing. How does this affect you? Well, as we know, more and more money was easy credit. So prices, let's say you had a property in America. Let's say, I'm going to show you some examples of properties today, and you're gonna like be amazed at the prices these things are. I'm going to show you what they were and what they now are. But let's say a property was $150,000 for a home. All the easy credits coming into the property market in the US, so they take off upwards, and they get up to say $300,000. Why? Because everyone's bidding for them. And that's what started to happen. So imagine your home in Australia is worth $500,000 and it got bid up to $1 million. You'd be like, on paper, you just made $500,000. And then what you've done is borrowed against that and went and bought. If I made $500,000 on one, I'm going to buy 2 or 3. All of a sudden, you've quit your job because you're making more money on paper, and you don't need a job because you just live off the line of credits because you're making all this money on paper. Does it make sense? And so even the taxi drivers were now property investors. Everyone was into property. 5, 6 years ago, when I was in the United States with a peer group of people over there that were doing well, a lot of them were full-time property investors. Now, interesting, here's what happened. One of my friends in the NLA, he's worth about $400 million. He bought 1,000 apartments in the 1990s. He made a lot of money by residential property. I remember having a conversation with him and a few others, and he was telling the people in the peer group, he said, you guys are nuts. You're leveraged to your eyeballs. You think you have all this money. It's all paper money. You have these properties, but they're up here, and you're living off your line of credit and developing more property. He said, you guys are crazy. If you don't sell, you're going to end up financially destroyed. He had the preemption to see what was coming. Because if you're in the market, you would have understood what was coming. If there's easy credit like this, you can predict there's something going to go. But people are like, yeah, but properties always goes up. It always has for 200 years in America. It's always risen. Let me ask you a question. Have you heard that before somewhere? So don't always be so complacent. Just because Australian property's been good to us, don't get too complacent, okay? We don't want to get too cocky in this country. I'm not suggesting the property crash would happen here, but I'm not suggesting it's not impossible to happen, okay? So as a result of that, prices going through the roof, he said to people, get out. So what he did, I remember telling people, get out. And he started selling his apartments. And he sold most of them before the credit crash. Did very well. Had 1,000 apartments. Sold them. And guess what he's doing right now? Has been for the last 12 months. Buying them. He's bought about 100 in the last few months. He's buying them. Interesting, isn't it? Smart, though. Is that a good way to make money? He got in the 90s, made his money, got out, and waited, boom, back in and buying. Okay? So the opportunities are pretty exciting. So because of that, what happened, obviously, people could no longer keep on getting easy finance. The finance run out. People were starting to default then on properties, and property values were up here. So imagine your property value's up here and you've borrowed against it. So you're leveraged up to maybe $250,000, and you're living off that line of credit. You might be worth $2 or $3 million now. You've quit your job. On paper, you're worth a lot of money. You're rich. You think you are. And then what starts to happen, no one more can buy property, so the demand for it, there's a surplus of stock too. The construction industry was building houses as quickly as possibly could. They were building more houses than they needed, okay? Because more and more people were buying them. And as a result, once the credit tap was turned off and defaults started to happen, guess what happened to property prices? Now, did they fall faster than they rose, yes or no? Just like the stock market, when they fall, okay? They fell rapidly all the way down to, depends on the city, but you're going to see properties. I'll give you examples today, pictures of properties in cities in America for $50,000 to $100,000 that used to pay $250,000 to $300,000 for. Is that amazing? It's just phenomenal. And that's what happened. Now, if you had a debt of $250,000 and your property's now worth, say, $75,000, what are you going to do? Give back the keys. You give back the keys, and if you're pissed off with the banks, you're probably going to gut the property, pull the electricals out, and you're going to go. Would you, even if you're an ethical person, go, let me see, I owe $250,000 on a property, it's now worth $75,000, am I going to pay off the $250,000 loan, yes or no? No way. There will be no point. Now here's the difference. In Australia we have recourse loans, jot that down. Over in America they have non-recourse loans. Make sense? It's much easier to walk away from the loan, okay? So as a result of that, people just walked away en masse. The banks are now stuck with all these defaulting properties at rapid rates, and you saw some of the figures on the video. Okay, 7 million default homes in America. That's as big as, we only have something like 8 million homes in Australia. So you see the mass scale of that. So default, and it comes tumbling down. The markets come tumbling down. Now, not all markets in America, but some in particular. Some markets fell as much as 60 to 70%. Okay, other markets only 20%. I think on average the statistic in America was 30% across the board. But to get 30% across the board, you know, there's a lot of properties that fall a lot well below that for the ones that didn't fall as much. Okay? So as a result of that, we now have properties in the US that the US has property market where the replacement value of a home might be $250,000 and the properties are $50,000 to $100,000. You know how we talked about yesterday intrinsic value? Or if you want to buy a company in the stock market and if its net assets are greater than its market capitalization, or if a business assets are greater than what you can buy it for, you can buy it undervalued. If a house to replace is $250,000 and you can pick it up for $65,000, who would be fully comfortable with that? Okay? Now, here's what stops some people investing in the US. One, well, you need to know this. You need to know where to invest. All cities are the same, yes or no? No. So we're going to look, what I'm going to walk you through, and I'm going to accelerate the learning process for you. Normally this would take a long time I'm going to make it fairly simple for you as much as I possibly can in the short time we have today, because you've got many other strategies to learn today. So we're going to look at what I have identified, what I call 4 particular categories of property markets in the US. Okay? And ones I alluded to some yesterday, the ones we want to avoid. I'm going to run through that why. It's just going to simplify. It's like a criteria for you. You can simplify your criteria. Now, you can have your own criteria. Is that true? You can invent your own criteria. You can jump on a plane and go to the US and do your own research, okay? But here's the interesting thing. In the mainstream media in Australia, there's been a lot of talk for the last 12 months about US property, and the talk is getting even more. Now, here's the interesting thing. There's some positive talk and there's some negative talk. There's people talking about going over there making lots of money, and then there's a negative talk about the disaster stories. Making sense? So what you don't want to be is a disaster story, okay? There is pitfalls you have to avoid, and you have to be smart. Number 1 rule, the first step in creating change is what? First step in creating change is awareness. So when we're going to use an investment strategy, the first step is to get what? Aware by getting educated. Making sense? By investing in your education, getting the homework done, getting yourself prepared, you can avoid the majority of the mistakes that novices will make. Okay? Would you like to know what the typical mistakes are that people make? Yes or no? Okay, so you can avoid them. So here's when the media says, and commentators say, some of them will say, it's dangerous for the average Aussie to go to the US or go to a website and buy a US property off the internet or go to the site overseas. Now, when I see some of those articles, I go, you know what, they're probably right. For the average Australian, I would probably say be cautious. Why? Because if they're uneducated, they don't know what they're doing, and if they jump... Now, some of the commentators wrote an article recently in the Sun Herald, I won't mention his name, but he was totally slandering US property 6 months ago. He did an article a few weeks ago and come out, tread your own path, come out and basically said that now you should invest in the US property market. But he's telling people now, jump on a plane, go over there and do it yourself. Don't go to a seminar and learn how to do it. I'm going, I can tell you what will happen to the average Australian. They jump on a plane and go to America. And then they rock up to a real estate agent in America. The first thing a real estate agent in America is going to notice is what? Australian accent. They love Aussies, but they also know, and if you mention, I'm an Australian, I've come over here to buy some US property. What are they going to do with their hands? They don't have any American buyers. No one else is buying. They like foreigners. Why? Because they know there is dodge. You got to understand, we have a certain moral and ethical code in business in Australia. Why? Because we are a small country. If you rip someone off in this country, it's small enough that people will find you. Is that fair enough? It's like if I grew up in a small country town, you're honest. You be your word because everyone knows you, and if you stuff up, if you stuff up, they can always edit it, I swear, so it won't matter. If you stuff up, basically, they will go and speak to your parents or the grandparents because they track you down by who your grandparents are. Is that true? Okay? If I go home to the country town now, there's younger people that I don't know, I say, who's your parents or your grandparents? And that's how I track them back who they are. So if people do something wrong, your grandparents are going to find out. So it's what we call social accountability. So people are far more trustworthy and honest and less, because you're going to be found out. In Australia, yes, you can get ripped off, but it's fairly, people tend to do the right thing because you don't want to ruin your reputation. In Europe, is it the same, yes or no? No. Europe is some of the dodgiest business places you'll ever do business with. America's sort of in between. America has pretty good business culture, they have rules, etc., but it's a bigger country, and it's not as, what would you say without offending Americans? It's perhaps not, you're more likely to get ripped off. Does that make sense? Because people come in spinner. So what you've got to do, here's the dangers if someone just jumped on a plane and went and did it themselves. Unless they're educated, unless they're sophisticated. One, they're going to be dealing with real estate agents. Real estate agents, you'll sell them property, true, okay? What they'll often do, or if they buy through the internet, is they will go for the cheap properties. Search on the internet and find cheap properties, and what they're saying, oh, there's $10,000 properties, there's $15,000 properties. You can do that in America. However, you're going to need to spend $150,000 on a Humvee with a machine gun turret to go and collect your rent. Does that make sense? The property may be cheap, but the US military is not going to collect the rent for you, okay? So there's reasons why it's cheap. It's like buying in an outer suburb of Broken Hill when Broken Hill shrunk half in size. Yeah, they'd be cheap, but they're cheap for a reason, because no one lives in that part, those streets anymore. There is cities in America that were bigger once small. We don't have that so much in Australia. It's hard for us to imagine a city like Canberra or Newcastle, or imagine Geelong even, if it halved in population. If it's cheap property, go down and buy some cheap property. Would you want to buy it though? So here's the other thing, the danger will happen is people buy properties and they're cheap, but on the inside they're being gutted. In other words, electrical wires, everything's been pulled out of them, and on the outside it looks great, but they're gutted on the inside. That's one problem. Another problem is tenants. You may not get a tenant in the area that you're in. It could be a bad area. You don't know the suburb, you don't know the city, you don't know where you're going to pick it. You're going to maybe pick a bad area, and there's a reason why it's cheap. Or what they're going to do, real estate agents will tell you can get this amount of rent, and when a push comes to shove, you'll get this amount of rent. Or, this is what happens, they will say you've already got a tenant in place, and you'll get your rent for 2 or 3 months. You're back in Australia, everything's hunky-dory, and no more payments. They never ever had a tenant for you. They were just paying your rent for 2 or 3 months. You bought it, and now you have no tenant, and it's in an area you can't get tenants. And they don't care, because they know you're in America. They know you can't come check on your property every week. You're not going to, you spend another $2,500 to jump over there to collect the rent, are you? Or, worst case, as sad as it is, you can be like the Australian recently that went to Detroit to collect his rent and check on his property. He was shot dead. You don't want to own properties in some of these suburbs. Why would you risk your life over an investment strategy? Does it make sense? It's sad. That just happened recently. So there is some dangers. Now, being shot dead is pretty dangerous. Outside of that, there are still dangers, okay? As far as getting a bad deal. So it's like anything, is I'm going to suggest that you, one, get highly educated. You do your homework on the cities. Now, I'm going to give you categories to narrow it down for you, and then you can go and check out what you think is right. So that will make it simpler for you. And you want to avoid that. Also rent, the idea of tenants that don't pay your rent, or the agents. Other thing that happens, agents, they'll have a tenant, but they'll pocket the rent and not pay you. And they'll tell you, oh, there's no tenant in here, we're waiting a couple of months, we'll get another tenant for you. But they're pocketing the rent. See, this doesn't happen in Australia, because there'd be like strict, there's different real estate system in Australia that's very regulated and very strict to protect consumers. In America, that doesn't exist. I don't think they even have a rental tribunal. There's none of that sort of stuff. Most people in America pay rent by cash. Make sense? And rent in America is a lot cheaper than what you pay in Australia. It's high returns because the properties now are so cheap, but it's a whole different game. So if you just assume... Now, it's also what the other mistake people make, even if you are educated, is you treat the US market the same as the Australian market. And you make some different mistakes, or you check for things you don't really need to check for, and you forget checking for things that you do need to check for. So it's a different system, okay? So you just need to know some of those systems. Also, there's tax structures I've got to mention to you as well. If you're going to invest in America, there's also finance issues as well. So I'll answer some of those questions for you. By the way, raise your hand, make some noise. You're actually interested in this? Yes. Just checking, okay, because it's not for everyone, but I want you to understand, you know, how this works and what's going on. So there's some of the common mistakes, okay, that you want to avoid, and there's a few others. So let's go through the categories now. These are 4 categories I've identified just from my observation of particular properties. So Jamie, okay, I'm with you. I'd like to maybe consider the US property market. What cities should I target? Okay, let's look at the categories that I think are worthwhile targeting and the ones that are not worthwhile targeting. Because there's a lot of internet companies in Australia now started up selling property, and most of them, as I talked about yesterday, selling property in Detroit and Buffalo and places like this. I don't know about you, but I'm not comfortable investing there, and I'm certainly not going to endorse those cities. You might find some good bargains there, you might get high rental yields, etc. You might get government paid tenants. Oh, that sounds sexy. But, you know, Detroit is, what's the main industry in Detroit? Car industry, automotive. What happened to that during the credit crisis? Got hammered. Even though now it's recovering to some degree, but it's recovering from bailout money. Okay? Long term, is Detroit a city that's likely to see property prices double every 10 years? I wouldn't think so. Buffalo, people got in the papers, some of the stories are about Buffalo. As I said, Buffalo is a city that had 600,000 people, shrunk to 300,000. You know, it's not a very pretty, nice city. And sure, there's cheap houses there, okay? But they're cheap because there's no one lives in the whole street. Okay, there's no tenants there. What's the point of a cheap house if there's no tenant? What you're doing with property in the US, you jot this down, you are buying a tenant. The number one attraction, well, there's 2 attractions to the US. There's 2 attractions, I'll say. The number one, well, they're probably both the same. The number one is obviously the cash flow returns. Okay, so in Australia, you would buy property only if you're going to get significant capital growth generally. True? In the US, you've got to understand it is worth buying property if you've got 0 capital growth at all. Does it make sense? So you have to say, if I get 0 capital growth, am I still happy to buy it? In some categories I talk about, some cities, yes, you would. Why? If you can get a 20% or 25% gross rental yield, which might come down to 15, 16, 17, 18% net, because there's more costs also. Not like Australia, there's more cost in the rental, so you need to know gross. See, in Australians, we know focus on gross, don't we? In America, you want to focus on gross and net. Okay, you definitely want to know what the net is, because there's a big discrepancy between the two. But if you can get 15, 16, 17% on properties, which I'm telling you can, would you like to see some this weekend at that sort of rental return net? Would you like to see some of those? We probably won't have time today, but on Monday, we will get some existing properties that are there. I'm going to show you some today of some of our 21st Century members have already bought. Okay, so you'll get excited by it, but you can't get them because they're already gone. But on Monday, I'll get them to show some of these sort of rental returns that are available currently, which you buy in the US right now. So I've flown out one of our 21st Century Property Acquisition team members from the US. I'm going to interview him in this session and ask him some questions to share with you his experience, what happened in the credit crisis, how long he's been in the property market, and what they specifically look for, what they do, okay? And the other mistakes I'll tell you is this, the other couple of mistakes, jot this down, is people buy properties unrenovated. You can do that. I'm not going to recommend it. It's a total headache. We've had to learn that way, even with some of our clients. Initially, some of them were getting, because they're getting slightly cheaper, unrenovated, untenanted. But the hassle of getting them renovated, not themselves, but other people still, the cost blow out of that, the time, then you've got to get a tenant. It's hard work. So one rule I've created, in 90% of the cases, and we've created a service for this as well, is that only buy properties that are already renovations done and the tenant's already in place. Why? You'll pay a little bit more for it, but it's a turnkey service where you don't have to do it yourself unless you want to be flying over there, getting builders and putting it together. It's just not going to happen. Unless you say, Jamie, I want to buy 100 properties, I'm going to set up my own construction company over there, I'm going to go and buy and do all the work yourself. If you're a big player like that, maybe you'll do that, okay? But otherwise, do you really have time? You're busy working on your careers to be worrying about in America if you have to do all this stuff yourself. You're going to be like, too hard or too risky, or I'm not really sure what I'm doing, I don't want to make the mistakes, and like I've got to run my other life as well. I can't be ducking back and forth because that's costly, just time and money to go over there. So there is costs involved. So if you can eliminate a lot of those things, then it becomes a little bit more realistic. Okay? Some of you are really big go-getters and are happy to put the time and effort in and go and do this yourself. So my goal today is to educate you as much as possible to do it yourself. I know most of you, though, are going to want it done for you. True? You're going to do like have a turnkey service where you can have them sourced, you can check the stock list, and they can be renovated for you before you buy them, tenants in place so you know the exact rental before you buy them, and you're dealing with people that we know, that you're not dealing with dodgy property managers, etc. like that, so you're dealing with real people, okay? So that can be taken care of. That just makes it a lot easier. And that's come from experience of working with our clients through this service to fine-tune it to get the headaches out of it. Because it is a bit of work involved, but if we eliminate most of that, it means it's a set-and-forget type thing. It becomes more realistic for the average person. Okay? Where was I up to? I was going to tell you one other mistake people make. The unrenovated tenants. So one of the rules I would recommend as an investor, get the ones that are renovated and tenanted, save time, money, hassle. Okay? So let's go through the 4 categories that we want to look at. This is only categories I've identified. This is part of the criteria process that I look at and what our property selection team looks at as well. Okay? And we're going to make it really easy for each and every one, and we're going to narrow it down to 3 particular categories we're going to look at, and we're going to look at the best city in America in each of those categories. So we're going to have about 3 markets that we would look for. They're going to have different outcomes. I'll explain what I mean. Okay, the one category is what I talked about the other day. Let's draw this one in black, shall we? This category represents the Detroit market. The Detroit, Buffalo type market city is, let's say red represents rents, okay? So you have high rents. And let's say green represents capital growth. Now, people go and look at the high rents, cheap properties and go, all right, I'm going to do this. They don't do any research. It's a little bit like yesterday, the stock market. I'm just after rental premiums. I'm not going to stick to Warren Buffett's rules. I'm just going to go chase the rental premiums. You might get away with it for a while, but in 2 years' time or 3 years' time, your property's gone backwards in value, or then you can't get a tenant because it's just a bad neighbourhood. And then you go, shit, that didn't work. Maybe I should have stuck to the rules, do a little bit more work, get that right first, and then be better off. Because this is what the mistakes a lot of Australians are making right now. High rents, but you're going to need the high rents. Why? Because you've got declining capital value. Or just properties that are falling apart, or in a neighbourhood they get wrecked, etc. expenses. So you're going to need the higher rents to offset that, so it defeats the purpose. Make sense? So for me, I'm not touching it. It's out the door. That's a Detroit, Buffalo type place, okay? Up to you where you invest, but that doesn't convince me as a market to invest in. Ironically, and it's what most of the sites in Australia are pushing, by the way. Why? Because it's cheap. And also they can make bigger margin on them, okay? So I would be careful of that. Here's the other markets. This is probably I would say the #1 market you want to go for, but I'm going to show you the other 3 as well. #1 market you want to go for is this market. What you're looking for is the best cities, I think, to invest in are the cities that, jot this down, that have experienced the most pain. They've experienced the most pain. Jamie, what do you mean by they've experienced the most pain? Well, who can tell me, take a guess, what is 3 cities in America, some of you may know the answer to this, that have had the biggest pain being the biggest drop in prices? Tell me what these 3 cities are. Las Vegas is one, yes, very good. What's another one? Florida, true, is the other one. And there's one more. Phoenix, exactly. These are what you want to look for, cities that had the most pain. Phoenix, Florida, mainly Miami, and Las Vegas that had the most pain. Why? Because they rose the most. In the property boom, they reached new heights. That's where all the activity was on and people buying heap. They went really high. That means they had more they could come back down to. Some of these markets have crashed 60, 70%. That's where you're going to see $300,000 homes for $50, $60, $70, $80,000. So does that narrow it down? That's one category we're going to target. It's called the pain market. What we're looking for is cities that will have what I call, in a basketball terminology, it gets the bounce back. In other words, they're going to bounce back up. So it went down like a basketball, but they're going to bounce back up. You don't want a city that's gone down, but it's like throwing a flat basketball. It's gone down, but it's not coming back up. Okay? So these are bounce back cities. However, do we just want to invest in the whole three? Well, no, we need to narrow it down. Would you like to know what I think is the number one city out of those three currently right now in the marketplace? Would you like to know what it is? Take a guess. It's Phoenix. Now, I know some of you are like, I'm just going to go to Las Vegas because that sounds sexy, okay? And I'm going to invest in Las Vegas at the blackjack table, and I might buy a property, okay? So, now, I'm not saying this is currently. Las Vegas in the future, it's one that you put on question mark pending, okay? There are some good deals in Las Vegas. You can buy them very cheap, but you're not going to see, I believe, a recovery as quick as the other markets. It's got more pain to suffer yet. Why? Because it's not growing as much. It's coming back, but there's a lot of stock there. There's a lot of surplus stock. That's what we're looking for. You can get it cheap. There's a lot of surplus stock. Miami as well. You can buy $50,000 condos, but it's a Gold Coast type market. A lot of high rises, so you're not going to get the bounce back. It's like you can go to the Gold Coast now and buy properties for 35% of what they were. Oracle and some of these places, 50% off. Okay? You can buy them at a good price, but you're not going to get the recovery for a while. Okay? So Phoenix is the market out of all our research that is the hot to trot market right now. Why? Most pain, bounce back, but rather than go into all the economic details of a city like Phoenix, we don't have time for that in this presentation. But when you do the research, we've had a lot of our members over there seeing the city, etc. I would know more about Phoenix demographics, industry employment, etc. about that city than I would probably about Melbourne, or Brisbane, or Sydney. It's just like we probably overcompensate when we're looking at another foreign market. We really want to do our homework. Is that true? So we're so cautious about investing in the US. We do all our homework, etc. And the property's like $50,000. Can you afford to stuff up on a $50,000 property? Yes or no? Yes or no? Absolutely you can. Can you afford to stuff up on a $500,000 property in Australia? Not really. Okay, it's going to cost you, because a $500,000 property in Australia is going to cost you $25,000 stamp duty. Can you borrow for stamp duty? No, in case you're not sure. No, you can't. You have to use cash. The $25,000 you would invest in a $500,000 property in Australia that's going to be negative geared, that's probably not going to grow a lot in the near future, is going to cost you money. That $25,000 just on stamp duty plus the deposit, say 20%, so $100,000 plus legals, etc. You're up to $130,000, $135,000 cash. $135,000 cash in the US market. What can you do with that? I can tell you now, you can buy 2 quality homes or 3 less quality homes and be getting, or in some markets I'm going to show you in a moment, you can probably buy 4 homes that you can get 17, 18% net rental return. Something to think about. Sounds too good to be true, doesn't it? But when you see it, different story. Okay? However, do you understand why it's such a good opportunity? This is a rare, abnormal opportunity. Now, the other thing is this. What has happened to the Australian dollar in the last 6 months? It's gone up to $1.10 back to what, $1.06, $1.07? Okay? So to buy these properties are even cheaper now. We have the property market in the US, the lowest it's ever been. You can buy at 1980 prices. Imagine in Australia, if you could go back to 1980 and buy property in Australia at 1980 prices. Who would be out there buying them? At 1980 prices, you'd be like, my God. Even if it would never recover back to today's prices, just recover back halfway, you'd be like, that's a good deal. Or actually, 1980 prices, you wouldn't care if it never recovered. Why? Because if you had today's rent, you don't have to care. You'd be like, you wouldn't even wait to the end of this presentation. You would be out that door and you'd be running, putting offers in on everything you could get. Making sense? Okay? Some of you going, how far is Tullamarine? Okay. Making sense? So we've got to compare this as like people, and then a $500,000 property for a lot of people is a lot of money to buy. If you buy 2 of them, it's $1 million over time. The returns are just not as exciting. We're $1 million in the US market right now. It will add it up. Jot down $1 million and add, let's say, just 15% net. You're not going to get that in all properties, but in some markets you're going to get more. But let's say 15% net. 15% net on $1 million is how much cash per year? $150,000. You know when you do your wealth bucket, $150,000 is well beyond financial freedom. Let's say you need $50,000 a year to quit your job. I'm not saying you'd quit it at that, but at least you'd be maybe work part-time. $50,000 a year. In US property at 15%, how much do you have to invest? $330,000? If you're going to get rich, you have to be good with numbers in your head, okay? Some of you going, I'm just going to wait. Someone else will yell out the answer. Okay, 15%. You want $50,000, okay? Is it $333,000? $330,000 worth of property in the US at 15% net is $50,000. Many Australians would be happy to say, you know, at $50,000, that's enough to replace my income, or that's enough to give me a supplementary income where I work part-time, or that's enough to just double my income. Making sense? $330,000. Now, $330,000 in Australian property, what are you going to get? What's the rental returns you're going to get? Net rental returns. 5 or 6 gross, your net, anywhere from 2 to 4%, 3 to 4%, let's say, depends what market you're in, but let's say 3%. What's 3% of 330,000? $9,900, 10 grand, say. You'd need 5 times as much. Plus the stamp duty on 5 times as much. Plus borrowing capacity. Hard to do that, and so you have to be able to borrow the money. Many of you will buy US property with cash, equity, line of credits out of Australia, or superannuation money. True? So in a lot of cases, you just pay cash for it. It's not costing you any interest. Now, I'm going to talk about finance in a moment, because some of you say, Jeb, you can get finance, you can buy twice as many properties and get there twice as quick. Okay, that's complex. We're working on that for you. It comes and goes, but it's possible. We've got some of our members have already got finance, okay, on properties, etc. It is possible. It's not available every month because it comes and goes. But even if you couldn't get finance, you can get finance in Australia, can't you? Get a line of credit on your property in Australia, pull it out, use that. You can use your superannuation, change your self-managed super fund. You've been taught how to do that this weekend. Some of you are setting that up. Some of you already have. You have cash, or you can save up the cash. And as a result of that, the potential is so much greater. Okay, so much greater. That's why it's exciting, because from A to B to get where you want to go, we're now talking, a lot of people go, my God, I can actually achieve that. If this is real, if this works for me, I can actually achieve that. And have we talked about the properties having to go up in value yet? Yes or no? No. This is saying if we get 0 capital growth, 0. Because I know why some people aren't excited about the US, because they go, Jamie, I've read about the US Federal Reserve and they're printing off all this money, the US dollar's going to collapse and the US economy is going to collapse, it's going to be a Great Depression, therefore everything's not going to do anything. So that's how people think, and then they're backing the one they won't invest. I'm going to tell you how you can still take advantage of opportunity if the US economy never recovers, if the US dollar does continue to crash. Yes, those are legitimate concerns. They can happen. But let's look at that, shall we? Here we're focusing on if we get 0 growth. What if you're in a bounce-back city? A bounce-back city, I believe, in the next 2 or 3 years will bounce back. Why? Let's look at the fundamentals. The reason the US property market crashes, construction industry, apart from easy credit, they were getting easy credit, they were building more homes than they needed. The construction industry was decimated with the property crash. They are now producing they cut back to 25% of the homes they were producing in America. It's now up to about 33%. I think I mentioned the figures yesterday. About 332,000 homes this year the construction industry in America will produce. They used to produce over 1 million per year. So they're not producing. Is America's population declining, stable, or growing? It's growing fairly significantly. So what is happening is they had this surplus stock. That surplus stock currently is getting eaten up. It may be another 1 or 2 years before it's completely eaten up. What's going to happen when the surplus stock is eaten up? Well, people then there has to be more homes built. The construction industry is decimated. Is it going to overnight be able to jump up to 1 million homes a year? Yes or no? Most of the companies are broke. Most of the people left the industry. It will take years to gear back up to $1 million, 1 million homes a year. Years to do that. So you're going to have surplus stock disappearing and demand for new homes, and there's not going to be the ability to build the new homes. It's going to even put even more pressure. This is even if the economy does not recover. You make sense? Now, don't believe me, there's some very rich people in America where I'm getting this information from. Does it make sense? That are doing the same thing. There is rich people in Australia, I'm talking seriously rich people in Australia, that are quietly doing this right now. There is funds being launched. You've seen them in the newspapers. Is it true? Funds right now where you can go and invest in to buy US property. That's how popular it's becoming. People like, the chance is there. So, as a result of that, where was I up to? What was I talking about? If they bounce back, now remember, jot this down. A bounce back is a what? A bonus. Bounce back is a bonus. If that happens, that's extra money for you. If it doesn't happen, who cares? You're still going to make money from the rent. You've got to look at it differently. It's not Australia. It's a different fundamentals that we're looking for here. So that surplus stock will disappear. What it will do is this. I am not suggesting whatsoever that the US real estate market is going to bounce back to 300,000 as an example to where it was. That is unlikely to happen. Actually, I would bet it will not happen. What I'm suggesting is this. Even a modest bounce back will happen with this. As people have to, there's no second-hand homes left, or not enough, so the new demand is for a new home. If the new home costs $250,000 to build, if that's the replacement value, a second home is now worth at least $200,000, would you say? Because if you can go and buy a second-hand home for $200,000, a new one's $250,000, and say, well, $250,000, or I can get a second-hand one for $200,000. It's going to pull the prices back up to at least 80% of the replacement value of new homes. Making sense? It's not going to jump all the way back up to 300,000 unless there was a crazy boom. That just won't happen again. Although it'll take a lot of decades to get there. But it can pull back up towards here. If that happens, you will become seriously rich. Does it make sense? Seriously rich. Because not only you made the rentals, but all of a sudden now, your property's quite easily doubled in value. And still, in a lot of cases, well below what they were. And still below replacement value. I don't know about you, people, see, here's what happened. People that are millionaires just go and make it happen. People that penny pinch, some people get this mindset, okay, well, I want to sort of make sure I'm getting the property at the right price. Christ, it was $300,000 and it's $75,000. Are you going to penny pinch whether you can get it for 73 or 74 and miss the opportunity? That's what people do. They're over a few $1,000s when the opportunity is there, how cheap they are now. Because you know what happens in the US market right now? When I bring Ben up here, who can share you a testimonial. When they're buying these houses, they go like hotcakes. And right now what's already starting, and we'll ask him and he can share it with you, is that people that are trying to buy the houses, the acquisition teams, etc., that are in the US and suppliers, there's a lot of them, they're now having to compete. The prices are already in some of these cities are starting to rise. Does it make sense? Because there's getting less and less stock and more demand for the stock. So there's already some slight rise in some of these cities. Some cities in America are falling, some are rising. Some didn't fall that much, okay? But there's not opportunity there where they didn't fall. Is it making sense? How long do we have, Jamie? How long do we have to really make this happen? It's hard to say. I wouldn't wait 6 months. I certainly wouldn't wait 12 months. I know the next 6, 12 months I want to get as much of this done as possible because the opportunity will still be there but not as good. Instead of buying them at 50, 60, 70,000, and you'll be paying the 100,000, maybe the 110,000. Still cheap to what it was, but you're going to miss that extra balance. Does that make sense? We don't know exactly. I don't know, but I'm telling you, don't If you want to do this, don't wait a year and go, I'll think about it, I'll learn about it, and then in a year I might do it. There's other strategies you can put back to a year because they'll still be there. This one may not be there. Making sense? We're at a unique time. Other questions people will have. Does that make sense so far? So that's what we're looking at there. If we get the bounce back, that is in a bounce back city. There is other strategies to look at. Now in Phoenix, it fits into this category. Jot this down. So it fits into this category where you get potential high capital growth. The main reason a Phoenix type city is the capital growth potential. So the biggest earner from a Phoenix is going to be more the capital growth. Okay, that's what you're going for, a bounce back. But it also has decent rents. You're not going to get the 15, 17% net generally in Phoenix unless you're getting condos and stuff, cheaper end properties, which I found from experience most 21st century members prefer the houses, the more quality type houses because you resonate with it more. It's quality, better suburbs, better paying tenants. You get a little slightly lower yield, but you've got a better quality tenant. It's up to you what you do, but I just know from experience. And I'll show you some of these in a moment. Making sense? So the rents are still good. Okay, put it maybe at this angle because it's not as high as some of the other markets. You're going to be getting 11, 12, 13% net if you go to the higher quality houses. Lower quality, you're going to get higher, but you're going to have, you have a few more hassles at the lower end because you have a different type of tenant. Making sense? How much do I need, Jamie, to invest in US property? Okay, anything decent, the minimum you're going to need is, I would say, 28, 30,000 minimum is probably the lower price point, okay, for something worthwhile. The average, I would say about 60,000 per property on average. Anywhere up to $80,000, $100,000. Some of you like to go into really higher quality homes where you can get $150,000 type homes at the topper end of the market. But most of you are probably going to be after properties around the $50,000 to $80,000, $90,000 price range. When I show you some examples of what 21st century members are already be able to get access to and take advantage of, you'll see the quality sort of homes you can get in that area. Okay. Does that make sense? So this is a bounce back category, and which city is the #1 in this area at the moment? Phoenix, okay? Now there's two other categories that I've identified in the US market. This next category is where we're not going for capital growth, where our capital growth is going to be only slight capital growth. We're looking for a city that is stable, didn't crash as much, fairly stable, fairly stock standard city, good demographics, but it's not going to take off rapidly. So you're not going to get as much capital growth. You get small capital growth, but what you're really after is what? This is where you're after high rents. This is where you're going to get your 15, 16, 17%, 18% net rental yields, 20, 25% gross in those sort of markets. And you're not worried about the capital growth. You just want a city that's not going to go backwards on you, that's going to get some slow growth, but it's a stabilized market. But what you're after is a high. This is a diversification. Most people go ideally for here, and then you might want to diversify into here. So you can do a bit of both. The other advantage here, you can get houses in these sort of markets much cheaper. So this, when you say a house, normally for something under 30,000, the bottom end here would be a condo. You're not going to get a house for that in Phoenix, unless it's a crap house. Here, in these other markets, you potentially can get houses for 30,000. Actually houses, the cheaper end. And then you can get the higher rentals. So what cities in America fit into this category? Can anyone guess? It's going to be cities like St. Louis, maybe a Memphis, but it's a bit underwater. Houston, I'm not really sure. Dallas, maybe? Dallas, Houston, yeah, possibly. Yep. More stable cities that are growing but not rapidly growing, and opportunities.
San Diego?
No. And any of those, San Diego, San Francisco, LA, New York, those bigger cities, you're not going to get the deals. They haven't dropped as much. You're going to be paying, if you want a city to live in, different criteria, but you're going to be paying you're not going to be getting the $50,000, $60,000, $70,000. I went to Miami in January because I thought I might be able to pick up a mansion on the water in the canals in Miami for a ridiculously low price. But the really high quality homes, you still pay a lot of money for them. Okay, so that was a bit disappointing. But if you want to go higher end, in Phoenix, there is a mansion I had a look at. $960,000 US, which is what, less than 900,000 Australian. Absolute mansion. I don't know how big it is, but it's massive. We're talking massive home you pay $5 million or more for in Melbourne. If you want to buy top-end stuff, there is some of that stuff. Sarah Palin, that lady from Alaska, she just bought one in Phoenix for $1.7 million. An investor bought it a few months before for $800,000, sold it for Sarah Palin for $1.7. So if you want to operate at the higher level, you can do that. Now, I haven't actually bought that one, but I'm considering it. Phoenix, remarkably, even though it's in the desert, you could end up spending part of the year there. It's actually quite an amazing city. It's not until you get there and see it. It's a beautiful city. People say, why do people want to live in a desert? Ask Americans. They do. Okay, so, but how's that? An investor bought it for $800,000, sold it to Sarah, presidential nominee, or about to be, for $1.7 million. It's a good deal, is that true? Those deals are over there as well. Okay, so if you do want higher end, I'll give you, I think they've given you an expression of interest form. The property acquisition team will take that away, but pretty much I'm going to give you the 3 cities that you want to target. But if you want that higher end, just say, look, I'm interested in $800,000 or $900,000 homes, and they might be able to see what you do for you, but most of you are not going to be looking for that. You're going to be looking for the $50,000, $70,000, $80,000 type stuff. True? Number 1 city in this category is Kansas at the moment. Jot that down. Kansas, stable city. We'll show you a short video in a moment so you can get to see a little bit about these cities. I thought Kansas was not even a city. I thought it was just on, Dorothy invented it or something. But when I'm going to show you a short video after we bring Ben up here, you'll be amazed at the city. It's like, it's a modern metropolis. It's like people there. So a lot of these cities we just don't know enough about, but you can do the due diligence, etc. You start to learn about the city fundamentals. But what we're doing, are we buying Kansas for rapid capital growth or for what? Cash flow. So some of you go, Jamie, I'm only used to America. I can get capital growth in Australia. I just want the cash flow. That's all I want to focus on. And that might be the market you focus on. Okay? Or I'd say, if you're smart, you probably do both. You're diversified here, higher rentals, a bit lower rentals here, but you're going to get the bounce back, so you've got a good diversification. True? Making sense? Now, one more market category I will cover for you, and this other category which I identified is really, it's more of a combination between these 2 markets. One where you're not going to get as rampant capital growth potential as a Phoenix, but you're going to get capital growth, okay? But one where you mightn't get, you're going to get maybe not as, you're going to get better rents than maybe Phoenix slightly, okay? So you might get slightly better rents, but not as good capital growth. It's sort of an in-between type category, okay, of the above 2. And there's nothing wrong with those markets. Can anyone guess cities that might fit into that category? What was that, sorry? No, Canada is a country, sir. What other cities? Chicago? Probably not. Someone said it. Atlanta. Atlanta is definitely one of those type cities. It's not quite a bounce back city, didn't get as hard hit as Vegas and Phoenix and Florida, but it's very popular. What other cities, anything like that? What's that? Denver? Don't really know enough, probably not. Ben, what would be another city that like an Atlanta? Or maybe a Dallas?
I'd say Dallas or San Antonio.
San Antonio, maybe Dallas, San Antonio. So, yeah, New Orleans. Yeah, we'd have to create its own category for that one. So the number 1 city that in this criteria is Atlanta at the moment. So jot that down, Atlanta. It's a type of in-between city. It's a fairly hot city. It's getting very popular now. People are after property. There is deals there. So it's a combination. So you can, that's narrowing it down. Does that help for you? You can go and do more research on that, etc. What I'm going to be doing at the end of this is, if you want to learn more about US strategy, we only have, how much time do I have, team? Wow, 30 minutes. We're going to do a lot more yet, but if you want more detail, I'm going to give you, there's some educational resources. We're putting a boot camp on, a 3-day boot camp of this, if you want to learn that. We're also putting on a 3-city tour. later this year in September. If you actually want, some of you say, I want to buy a property, but I really just want to go and check them out and see the properties with my own eyes so I can really believe it. Who'd be in that category want to do that? So if you want to do that and go to America, I'll talk about at the end a 3-city tour that you can go on, okay? And take a guess which 3 cities. At this point, it'll be Phoenix, Kansas, Atlanta, and it will finish off in Las Vegas as a farewell night in Las Vegas, okay? So you can celebrate in Vegas. And then I also talk to you, if you say, Jamie, I want this done for you, we have a whole division that's been set up. They put copious amounts of time, energy and effort into it. I'm telling you this, to pull off a service, to do this is not easy. So they've been working around the clock, they've been doing it for months. It's a lot of work involved, but at 21st Century our goal is to educate you so you can go out and do it yourself, but if you want help and a turnkey service, you can become a US property member, and that will get you a turnkey service where they will source properties for you, you can select them, they will do all the work, and I'll go through in a moment a checklist, a quick checklist. You actually have a copy of it there for you. The things you pretty much would have to do to go through that. Does that make sense? So here's what I want you to do very quickly. Turn the person next to you. Just teach them what you've learned already about the US property market, and then I'm going to, in a moment, bring Ben up here. Do that quickly. Is this making sense so far? So we're going to look at, okay, let's narrow down a criteria, create your own criteria or model a criteria, narrow it down to what cities we're going to focus on, and then you get micro level where rather than going to teach you which suburbs, the acquisition team, that's what they focus on for you, but in a boot camp or in a 3-city tour, when you'd learn the micro levels of which particular suburbs, what type of properties. We don't have time to go into that now. Does anyone have any questions at this point in time before I go through a little bit more about the cities? We'll take a couple of quick questions and then I'll bring Ben up in just a moment. Just a microphone over here. Yeah, thanks, Ralph. What team are you in, Peter? Team 6.
Team 6.
I was interested in the, you said the non-recourse loans. If somebody has a mortgage on a property in America and they walk away from it and you buy that property, are you also then lumbered with that mortgage? Because I hear that the mortgages in America work differently than they do in Australia, where in Australia the actual person who takes up the mortgage is responsible.
Yeah, in this case, generally, Ben will answer that question when he comes up. But generally, in what we're doing when we're buying property, we're not buying the mortgage, we're just buying the property. Okay, so the mortgage isn't our problem, the past mortgage. We can take out a mortgage, but on the property for ourselves. But that's a different strategy if you want to just take over mortgages. In this case, we're not taking over the mortgage. No. Yep. Okay, so let me run through some examples of some cities to get you a bit of an idea what these cities look like. Then there's a few other things I've got to cover and interview Ben, and then I'm going to show you, who wants to see some actual property prices. You can actually see what the houses look like, what prices they were, what they are. That'll give you more insight. Then I'll also show you a quick video, 2-minute video also of a bus tour and run the property tour, actually go and look in some of the properties of some of what 21st Century members already been doing, so you can see that. Then I just want to also then make sure I cover for you the Australian dollar. Some of you will be thinking, what happens if the US dollar crashes or our Australian dollar drops down or goes up even higher? How those things are affected, because that'll be, some of you will be thinking about that. And I think that's pretty much then, in a nutshell, what you need to know to get started. I'll then mention about the boot camp dates, etc., and then the membership service, if you want this done for you, how that works as well. Then I'll have to do it really quickly. Touch on finance and the structures, quickly on the structures. I don't think Warren would have covered US structures. I'll touch on that very quickly for you because we're almost out of time. Can we maybe have a quick look at, is it Atlanta we're going to look at first? Yep, let's have a quick look at a video of Atlanta. It's just a preview of Atlanta so you see what these cities look like.
Atlanta, America's fastest growing city during the last decade, is a thriving market, which offers an endless array of real estate opportunities, both for cash flow and potential capital growth. Additionally, lifestyle choices are abundant for both city dwellers and surrounding occupants. America's Southeast is the 4th largest economy in the world, with Atlanta as the hub of its economic activity, boasting global air services, a deep talent base, sustained population growth, and a strategic national location. Atlanta is also the cultural center for the state of Georgia, with a vast choice of arts available to the public, including the High Museum of Art, the Atlanta Symphony Orchestra, and the Atlanta Ballet. Investment in Atlanta is quite obviously the wise choice for those looking to capitalize on equity growth in an area that supplies both strong and thriving business opportunities as well as established stable property trends. Atlanta has proven to illustrate that current pricing is nearly 60 to 70% below the cost to build, which relates to an exceptional opportunity for potential long-term appreciation for years to come. Atlanta is the clear choice when comparing value, location, and most importantly, economic recovery. Our homes are packaged specifically for passive investors seeking turnkey cash flow. All of our income properties are freshly renovated and potential cash-on-cash returns range from 10% to 17%, and each property is locally managed by competent property managers for ease and peace of mind ownership. Each home is purposely located to complement the expectations of a potential exit strategy for would-be future homeowners. Convenience to mass transit, schools, shopping, entertainment, and employment position each home for mass appeal. Georgia itself is the sixth best state for total tax burden, and Atlanta provides its residents with a low cost of living, 6% lower than the national average. This combination of factors presents the ideal time to capitalize on Atlanta real estate. It's easy to see why an investment in the Atlanta property market is a sensible and secure choice.
So who now knows everything about Atlanta? It gives you a bit of an overview of the city. That's just a little bit. We're now going to just a moment have a look at Kansas. But at least you can get more of a feel for a city, at least getting started with it, where these cities are, what they look like. Obviously, in the boot camp, we'll go through the demographics and on all those things in detail about a city. We just don't have time for that now, so it's just a bit of an overview for you. Do we have the Kansas one ready to go? Let's take a look at this one quickly.
A city is much like a person. After all, it does have a personality. And some people, as with cities, you just can't help but like. Some are full of surprises, and most people, at some point in their lives, seek to reinvent themselves. They desire to be better, they want to be more. Kansas City is one such person. This is a place of fountain, of beauty, of greenery and space, but also a stunning vibe of arts and culture. Makes sense that the Crossroads Arts District is just 2 blocks from one of the most creative places in the world, the headquarters of Hallmark Cards. And people have come here just for the architecture and shopping that awaits at the world-renowned Country Club Plaza. And the barbecue adds the sauce to our city. And yet visitors here have always been surprised. What had they imagined? If they were expecting to encounter folks, they've not been disappointed. Folks here helped create something called jazz. And today, one is redefining funk as we speak. It's been a city of action and those who create it. Of those who changed the world and captured the way it felt. We've given the world unmatched optimism and improbable comebacks. But what happened here recently could not be called improbable, nor a comeback. Someone once said, when you're through changing, you really are through. And Kansas City's $5 billion renaissance would suggest that we were not anywhere near through. 14 square blocks of downtown have been completely revitalized with a new entertainment and retail district that is just steps away from the convention center. In fact, our new attractions, museums, and performing arts center are enough to have turned many perceptions of our city completely upside down. Or right side up, depending on your perspective. We didn't invent the concept of a city. We didn't even reinvent it. But we desired to be better. We wanted to be more. A city known for being so friendly, so affordable, and so clean. It can now excite your senses and leave your heart racing. And we have emerged, perhaps not quite so humble as before. We didn't change our spirit or who we are. But surely few cities have had so much positive change in such a short time. It would appear that we were the folks we were waiting for. Surprised? Don't be. Kansas City, change your perspective.
So who has a different perspective on Kansas City? Somebody like, I didn't have any perspective, but at least you have. So it gives you an idea a bit about the cities before you go there. What we're going to do now is just show a video. First of all, I'll bring Ben up. Can we give Ben a very big hand? Thank you. Ben's someone flown out from the US. We've asked him to come out here and share with you, tell you a little bit about the US market. Ben is an investor. Ben, how long have you been in the real estate market in the US for?
I bought my first investment property in 03.
03,
As
yep.
soon as I got out of uni, is what it's called here.
out of college over there.
College, yep.
And you live in Kansas, that's right? So
Kansas City, Missouri. I live on the Missouri side, but yeah.
Yep.
Yep.
And so, how was it going through the credit crisis in 2008 it was, yeah.
Yeah, well, you know, there was a lot of money made in real estate on the way up. You know, you talked about a few specific points and some of the things that fueled that. But the net result for investors like me that were on the street, there was a lot of money that was made simply because you could not supply property fast enough. You could not, there was no shortage of people that could come to the table with money to buy. There was no, the lending requirements were so loose that there was just buyers that really had no business buying that were buying multiple properties. So as a result, of course, there was a lot of money made. Now, certain people like myself, I certainly didn't buy excess properties. I didn't leverage myself to the hilt. When all that was going on, myself personally, I had a few rental properties that I'd buy per year. I didn't get excessive with it, and those are properties that I still own today. There's some other people, of course, one of my good business partners, and you know Tyler, you know, he actually was gaining massive wealth, massive millions, you know, pulling it up. When everything fell out, his business was set up in a way, and his properties were set up in a way that he lost a lot during that time. And so that was pretty tough. Now, in the city that I live in, Kansas City, Missouri, it's a very stable city. It's one of the most stable cities in the country, not only for real estate prices and things, but also just for local economic factors. Several of the major U.S. companies are based there. Some of them are household names in America, but Sprint, Hallmark, H&R Block. I don't know if these names ring a bell at all with you, but those are certainly household names in America.
So are you saying with the Kansas market that you didn't see a dramatic fall, like, say, obviously the pain cities that we talked about?
Right. No, we didn't see a big fall. Certainly we had our share of foreclosures. Certainly when times were going up, there were people in Kansas City that were buying property that had no business buying property. Those people have all lost their properties.
Yeah.
Okay. But no, we didn't see the dramatic highs. We didn't see the dramatic lows. Now, when other parts of the country were going up at 25 and 30% a year, Kansas City was going up at maybe 7 to 8 to 10% a year. You know, And at the same token, when all the other markets were crashing at 30% a year, Kansas City was falling at about the same rate that it was going up. So Kansas City and St. Louis are two cities that we are heavily involved in investing in because of the demographics. They're very similar markets. We identify Kansas City and St. Louis, Missouri, we identify them as one market when we speak about markets because they're so similar, not only geographically, but also demographically and economically as well. So again, no, we didn't see the huge hard pitfalls. Kansas City and St. Louis today are still very good, solid cities. The unemployment is lower than the national average in those cities. Job availability is good. The pay is good.
And just with what sort of rental, I'm going to show some examples, but so as far as rental returns in Kansas, price-wise for properties, rental returns?
Yeah, you're looking at, you know, in Kansas City, you're looking at anywhere from $30,000 to $35,000 single-family home, maybe a smaller, a two-bedroom, all the way up to maybe 55 to 60 on the higher end of our price points.
He likes the idea of that, by the way.
And then, you know,
it sounds like talking about monopoly, doesn't it? Like, I mean, you can't even pay your stamp duty bill on Australian property.
And the $60,000, you know, that type of house, you're looking at a, you know, 4-bedroom, 2-bath, 1700 square feet. I'm not sure what the conversion is with meters. What is it? Somebody told me back here. 10.3, whatever
I've been
it is.
told before, but
Yeah.
the people, Generation Y and X would have no idea. The baby boomers should know the conversion. 3 to 1. 3 to 1?
3 roughly. Anyway, that property that you're buying at that, again, and that'll rent for, you know, $800 to $950 a month for that investment. So.
Amazing. So in a moment, we're going to actually show you some photos, some examples of properties that have been taken in most cases. And then the Phoenix market, obviously, you know, you do a lot of acquiring properties in the Phoenix market. How you found the Phoenix market?
The Phoenix market, we basically, the demand drove us to Phoenix. There were a lot of people that said, hey, listen, we want a market that is really high growth potential. We're not so concerned with the cash today. We're happy to get, you know, 8 to 10 to 12% net return, but we want something that has a really high future growth potential. And so what we did as a company, we went around to some of the hardest hit areas of the country and said, okay, these are the markets that we feel are going to come back. Now, what are the best markets? What are the most positive attributes? Where can we go in and really feel comfortable investing our own money? And knowing and also providing investments for our clients. So some of those cities, and we narrowed it down, and we eventually settled on Phoenix. Phoenix, you mentioned, is kind of funny. You said, ask Americans why they want to live in the desert. I mean, I don't know. Well, there's a lot of reasons why people like Phoenix. The climate is very good. There's, you know, out of 365 days of the year, I think it rains maybe 20 or 25 days. So the climate is good. There's a lot of people with health conditions that actually get doctors' waivers to be able to move to Phoenix, and the government gives them all kinds of tax credits and things to be able to do that. If they have certain medical conditions, to live in that climate, that dry climate. But what's funny about Phoenix, and there's a few other cities that fit this, but back when everything was going up, when the money was loose and the credit, people, you know, when you have money, you sort of have more freedom. You have more opportunity. You have things, you can do things that you may not do if you didn't have the money. So there was a lot of money floating around. The Phoenix population just grew tremendously. People want to live in Phoenix. It's a very high demand city for Americans to live in. There's a few cities like that. Phoenix is one of them. So back when the money was a little bit looser, we saw the prices of the houses and the demand. We saw the population swelling. And so you know just from that it's a very good city for people to want to live in. It's a very high demand city in America. Right now what we're seeing in Phoenix after the hardest hit, one of the hardest hit cities in the country, right now we're seeing high levels of investor activity going right back into that city. So we know the demand is there. We know the demand is there for people to live there. We know the demand is there for people to invest there. You know, being an investor sort of on the street and doing cash deals, cash deals, we're buying straight from banks, we're competing with other guys that are like us that have cash and the ability to write checks quickly. We're seeing massive amounts of investment activity in Phoenix. You know, it's one of the areas of the country right now, not only international, but we're seeing a lot of domestic money being invested right back into Phoenix. A lot of the large money groups, a lot of hedge funds and things in America had their money on the sidelines or investing it in other places. Right now, we're seeing that money come off of the sidelines or from other places and go right back into residential real estate. Phoenix is one of the areas that we see that in. I was talking to a hedge fund manager about a month ago, and he said, you know, we've got about $100 million that we're wanting to invest in residential real estate. We've identified 2 cities that we want to do this in. Phoenix is one of them. And so we had a conversation about that. A lot of our same reasons of why we're there were the reasons that he's there. And he said, you know what? We have probably what we think is maybe a 12-month window that if we don't buy about 10,000 houses in this time, we're going to really look back and kick ourselves for not doing that. And so again, and it's not international money, this is American guy with US dollars, which is not worth near what your dollar is, comparatively. And so again, the money's coming off of other places, the money's coming off the sidelines, and it's going right back into residential real estate. So now's at a very exciting time. There's a window of opportunity that we won't see again, not while I'm alive. That's in a very exciting time to be in some of these markets.
So you get that message, you don't buy at least 10,000 properties, you will be kicking yourself. But it's true, big players are now moving the market, and that's when you watch that, there's usually a trend happening there. Would you like to see some Phoenix properties? I see some examples. So we'll go through, you might be able to walk us through some of these as well. So here's one in Phoenix. So if we look at it, you've got the stats there, we've got the estimated market peak was, what, $190,000. And these are ones some of our 21st century members have already bought in recent times. So real live examples of what they're able to pick up. And they were able to get that at $66,000. Gross yield 14.5%, and net yield 12.7%. So talk us a little bit about that house. It's a standard one, or a little bit below the quality of some of them.
This particular property is what we feel is sort of a mid-range product in Phoenix. There's a higher-end product in Phoenix, there's a mid-range product, and there's a lower-end sort of condo product out there. This is sort of the mid-range product. It's very good. You're sort of middle of the road as far as what you're going to see with net returns. This particular property is actually pretty good on the net return side, being that it's a sort of middle of the road property class. But this particular property is a 3-bed, 1-bath. It's in the west side of Phoenix. If you look at a Phoenix map, and of course we don't have time to go really into all the details, that's what the boot camp's going to be for. But if we were to see a map, there's certain areas of Phoenix that we want to avoid, there's certain areas of Phoenix that we like, and we'll go into reasons for that. This property is obviously one that we like, in an area that we like, that's on the western side of the city, and it's moving toward the suburbs of the city.
Okay, fantastic. So let's look at a couple more examples. Okay, so here's, this would be probably, I guess, the next range up, would you say? This would be, yep. Mm-hmm. So you can see the estimated market peak, this was a few years back, $240,000. 21st century member picked it up for $87,000. Gross yield 12.5%, 10.5% net. What sort of, that's in, which suburb is that? That's Buckeye.
That's Buckeye. That's a suburb west of Phoenix. Phoenix proper, you saw the last address was actually Phoenix, Arizona. This is Buckeye, Arizona, and there's several suburbs immediately surrounding Phoenix that are, say, El Mirage, Maricopa, some of these other, Mesa, Gilbert. You'll see these addresses as you see the list of stock that comes through. This particular property is on what we call the higher end. We actually call this the Buckeye model, just because we do a lot of investing in this particular suburb. And this property is built in 10 years ago or less. These Buckeye model, I'll just tell you the model. We typically focus on properties that are 10 years old or newer, properties that are at least 14 to 1,500 square feet, 3-bed, 2-bath plus, and ones that are in neighborhoods where it's very high demand for owner occupants to live in. This is the sort of the next step up. You see, one of the things that's going on in cities like Phoenix is that people are losing their home ownership, but they're not losing, or they never will lose, their need to live in a home. right? So owner occupants are now becoming tenant occupants, and they're wanting
just
to
on
live.
that, I think you have an article, which was, I was in Phoenix a few weeks ago, and that we got that article out of the paper where they're talking about that because a lot of people say, what's going to happen in rental prices? With all these people that are being kicked out of the homes, foreclosure, they're all renters. So, I mean, what's your prediction of rents in the next 10 years? I imagine you'd...
Well, rents are going to go up. They have to. I mean, it's a very simple supply and demand curve that we're going to see happen. The supply for rental properties is, the demand for rental properties is going up because there's more renters. And we're not seeing new houses being built. So it's not like there's an abundant supply out there for rental property. So I think we're going to see rental prices come up a little bit. I wouldn't say it's going to be a dramatic increase, but certainly there will be an increase.
So when you factor that in over 5-10 year holding strategy, that's what you want, or longer, you can factor in the increased rentals, which is significant. The rental, who's happy with the rentals already? Okay, and this is in a market where we're not talking to high rentals. We're talking higher capital growth, bounce back city. We'll show you some in a moment. So of Kansas, we get much higher rentals. So let's look at another one here. So here's a house, 218,000 it was. 21st Century Member picked this up for 89,000. Gross rental 11%, net 9%. Let me ask you a question. In Australia, in Melbourne, suburb of Melbourne, what would you pay for a house like that? Take a guess. 450. And can you believe this? And it's not until you actually see it. I mean, there's a picture of it, but you actually can walk past these homes or walk in them, and you see there's a home that was 218,000, but if someone picked it up, a 20th Century man picked it up for 89,000. Is that amazing? And that's a house that is in a bounce back market. Okay, it may not ever get back to 218,000, but if it gets halfway back, who would be happy with that? Halfway back. If it does never recover, it stays at that price. The rentals, that's what we call the lower end of the rentals in the US, and we would dream about those rentals in Australia. Make sense? Okay. So tell us a bit about this property. This is probably the higher end.
Right. This property is still in what we consider the Buckeye model. Same example as the last property. You see on the bottom there, it's got the beds, bath, and square footage. This model, it's funny because when we were on the bus tour, we were in Phoenix. We took people, just the map and the way we had the bus tour planned out, we took people kind of to the condos and then to the mid-level properties, and then we finished up the rest of the day at the higher end of what we call this Buckeye model. When we were pulling up to some of the communities and we're pulling up to some of the streets here for this Buckeye model, people got off the bus and they were just like, wow.
Yeah.
Wow. That was jaws were hitting the floor. Guys are like, I mean, I can't believe you walk. They see this house. It's different. You see it in a picture. It looks nice. But when you actually see the house, I mean, it's almost a brand new house, just a few years old, in pristine condition. You're able to walk through this house. We had people going, and you'll see, I think some of the videos will show. But it's just, people could not believe that you could buy this property for less than $100,000. Yeah. I mean, it is unbelievable.
Amazed just by seeing the picture of it, let alone seeing it. When this is what's about. We're not talking Detroit suburbs here that you can't collect the rent. These are actually middle class suburbs, aren't they? They're like they're
these are
nice
places.
Suburbs.
These are places where people want to live. This is a high demand. These are the cities that the communities that were growing out of when Phoenix was growing. These little suburbs started being built.
Just Ben, just put it up on the screen. You might be able to show them. If we see the map.
Yeah. Let's actually go. You've got this one's in El Mirage, and then Buckeye. There's sort of the Buckeyes further out west. But those are the neighborhoods people want to live. Those are, and it's kind of funny here. People explained to me and said, well, in Australia, the closer you are to the CBD, the closest you are to city central, the higher the value of the property is, and the more people are wanting to live there. In America, not the case. It's just not the case. Hey, we're happy to drive 30 minutes to an hour from our home to get to work if we work in the city. There's no reason for us to be in the city other than work. Because in all of these other communities and suburbs, they're their own little cities. They've got their own little county, they've got their own little city governments, they've got the Walmart, the shopping center, all your conveniences and you know, all your needs and wants are all served in the smaller community.
Yep.
So there's no need to really be in the city unless you're working in the city.
So just on that, Ben, because that's why I talked about, remember, in the beginning this morning, I talked about the criteria we have for Australia. It has to be slightly different for the US, because we've looked out in the outer cities of Phoenix and going, yeah, nice houses, but they're a long way out of the city. Wouldn't we want suburbs closer? But in a lot of American cities, the suburbs that are closer in the city are not the nicer suburbs. You don't really want to be in some of those. Americans like to live in the suburbs, as Ben's saying. So.
Yeah.
It is a slightly different criteria. We use the same reference for Australia to there. It doesn't always quite work. We've got to be willing to be flexible and adjust our strategy so we get the right result. But most of you probably say, who cares what suburbs? And if it's 89,000 looks that good, we can't do that in Australia. So that's pretty amazing.
And you know, it's the reason you're here is to be educated, and it's the most valuable thing you can have is your education. When you're talking about investing in U.S. real estate, and you're using an Australian investing mindset to go over into this country, you're really going to fail. I mean, you just are. There's too many, like Jamie, we've covered this, you know, some of the things. There's just too many differences when investing in Australian real estate that there is investing in American real estate. Not only the differences in capital growth and what your goals are and this and that, but also just the difference of the American mindset. You have to think, who are my customers? Who are my clients? Well, your clients are your tenants. Your clients are people that are going to be living in your house. What are they thinking about? Okay? So that's why you're here today, and that's why in this boot camp that we're going to do, we're really going to educate you and teach you exactly so you can go out and do it on your own. Now, we'll give you a turnkey option to say, here, we've already done it, here it is. But at least you'll be educated. You'll know why. You'll be able to say, okay, I know this property. I'm thinking in terms of America and maybe where I want to live and these types of things. You're now an educated investor. You can now go in and really feel confident and say, listen, I know what I'm doing in this market. I've got people that are on the ground. I've got people behind me that are educating and supporting and teaching me these things. So again, education is your number one thing. It's just a different mindset from American real estate investing is what you might be used to.
Yeah, definitely. I think that's important. Okay, let's look at, we're going to show you a video very quickly of the actual bus tour, so you'd like to see some actual insides of the properties and how they look. I'll just show, do we have that ready, team? And we'll come back to the PowerPoint. Let's just play the video quickly, yeah. Thanks.
Look, they're tenanted as well, so that's a bonus. So, you know, the people will just move in. It's not for us to live in, and that's one thing that I've actually learned since being on this trip, you know. Pretty full. We've spoken to some local people. They love this area. The management of this place has changed, so things have really improved. So.
First impressions of properties in the US, in Phoenix,
I love these condos. They're fantastic.
Yep.
Yep, I think they're a good buy.
compared to Australian property?
Cheap.
So you had a look at your first property on the 21st Century Tour?
Yep.
How'd you enjoy it?
It's good. It's good. It's actually nice to, you know, sort of see the product after the couple of days of education. And yeah, I was impressed with the quality of the property. I like the fact that it's going to be, it's more, they can take care of things here for you, so it's a turnkey solution.
But that was a condo development. I think one 20th Century members here bought 3 of those at 42,000 each, 2 bedrooms. Is that true? 2 bedroom, 1 bathroom. But there's most of these houses, they're all gone anyhow. So later at the boot camp, I promise you will see proper video footage all the way through the houses, not just the condos. You get to see that. So because some of you are like. Some of you are happy to fly the States, spend your time and money to do that and see it. Others of you are like, Jamie, I can only do this strategy if I don't have to spend the money to fly to the States. I don't have the time if you can just do it all for me, okay? Some of you are in that situation. So I'll cover for both that you can do that. I've had the team say, guys, I want a system where members don't have to go to the States. It's only if they want to, where they can sit from home, and we'll show you then when you go to a website, you can select the properties. It's a matter of in order of ranking, because when the properties come out, you might say, yeah, I want that one. Let's say you wanted this one, and then there's 10 other 21st Century members. When the list gets emailed out to you, if you're on the list, and they want it, it goes on ranking who gets it. You say, yep, I want it. And then whenever you're joined as a US property member, whoever's highest ranked on that queue, they get the property. Does that make sense? Okay. So what our goal would be to do if you want to do this is get you prepared so you're set up, ready to then take action, because there's a bit of groundwork to do, which I'll mention in a moment, so that when a property comes, you're already set. You can just take it if you want it and get it, then you're more likely to get it. Does that make sense? Because as Ben can talk about, I mean, the stock that he acquires is not just for 21st Century. The stock goes rapidly because there's investors chasing this sort of stock. Those sort of prices, they're not going to last because people just want them. So we're talking sometimes only a matter of days that you've got. So we'll always, if you're on the US member, you'll get we'll do our best to give you a warning notice and say, guys, in 2 days' time, new stock's being released, so you're ready for it. So when it comes, you know to check your email that day, not wait a week and I would have bought that one, okay? But we'll also have showcase days, etc., for you. We can come to an event and they'll showcase different ones and go through it all and ask your questions. Let's skip through one here. Let's look at the, not this one, let's skip through that. This is the last one in Phoenix, a different one. This is a condo in Phoenix. So this was $90,000 a few years back, $34,000 now. 20th Century member got it for $34,000. Now you see the gross yield, 19.4%. The net is 10.2. When you go into condos, you will get higher rental returns, okay, than houses, but you're not probably going to get as much capital growth, and you're going to get a different demographic. Is that true?
That is true. The tenants that are living in the condos in the city are not the same tenant as the guy living in the Buckeye house that's 1,500 square feet that was built 5 years ago. That's pretty simple to gather, right? In the city, you're not that. Again, we're going to focus on areas of the city. Again, we've eliminated areas that we absolutely won't invest in, because here's one thing I want you guys to keep in mind. Myself and my companies, we're not simply brokers of a transaction. We're actually principals in a transaction. What that means is that that's all of our cash invested into these houses. That being said, we have to always hedge our bets. We have to think about it in the back of our mind and say this: what if these properties don't sell? One day, it would just say that everyone quits buying houses and we're going to be left with this portfolio of investment property. We have to be sure, just to protect ourselves, that this is a property that we're actually very comfortable and happy to hold on to for the next 10 or 15 years or whenever it would sell. So just keep that in the back of your mind as we're talking about properties, and as I'm talking, as we're talking, we're meeting in the hallway or whatever. We are vested interest parties in these transactions. We're not simply brokers, so we actually care about where our money goes. So I'll just preface it that. So again, the condo model, it's the lowest end model that we offer in Phoenix, and it's probably the lowest quality of tenant that we're going to find for our own portfolios in Phoenix. Again, does that mean they're bad people? No. In the interview in the video you just saw, one of the members was interviewed where they actually spoke. A lot of them spoke to some of the tenants and some of the people living in the condos. And are they good people? Are they good people? I think, Kelly, you were on the bus tour in Phoenix.
Yeah.
What was your impression of the quality of the tenant and the condo?
They loved living there, and they were friendly and happy to talk to us. And,
right.
Yeah, we sussed out all the tenants. Quite a few of us would talk to the tenants to see what it was like to live there and what it was like to be a tenant. And they were all perfectly nice people.
Yeah, you didn't have thugs, gangsters and stuff coming out of the behind the buildings to come get you.
No.
No.
We were going to, in the condos, we were going to tell them there was a gas leak so we can get the tenants all out of the property so we could go and look at them all. The fact they don't have gas there anyhow, they still probably would have worked. So that's good. So let's look at a couple of Kansas ones so you can see the difference in, you're looking at a stabilised market but higher rental returns, different sort of product. Diversification. So here's, now you're looking at houses, 51,000, gross yield, you see they jump right up 20%, gross, net 16%. Does it make sense? Now you're talking about what we talked about before. You're actually looking at, tell us a bit about this house.
Yeah, this house was recently renovated. In fact, our company owned this property. This is the second time we've owned and sold this property. We did it back in '06 as well. And actually sold it to an owner-occupant at that time. They got foreclosed on. We ended up getting the house back and renovating and everything again. This property is a 3-bedroom, 1.5 bath. It's in a part of Kansas City that we like. There's certain parts of Kansas City that we will invest in, and we'll go more into detail of that again during the boot camp. But this property's got a new roof, new flooring, new plumbing, new light fixtures, new everything. And it's typically a brand new house. One of the things I will mention when it comes to Kansas City and St. Louis and some of the markets that we find older properties in, like for instance this property. Is probably 75 years old. Okay, somebody say, "Wow, that's a 75 years old property. Do I really want to invest in that property?" And some of them are 100 years or better, years old. One of the things about these older homes, if you've ever been in an older home, they don't build them like they used to. Okay, back when they used to build these older homes, they actually used real wood. This stuff that you try to saw it today, it's almost impossible. It's petrified at this point. But we go in and we basically put a new home together, all new guts, as we call it, new plumbing throughout. New electrical we run, new electrical boxes, basically new fixtures everywhere. It's basically a brand new house with a very old solid structure. So I know that's one of the concerns I've heard over and over again. Yeah, this house is 100 years old. It's like, yeah, it's 100. It's been there for 100 years. It'll be there for another 100. With all new updated guts, if you will.
Yeah. So what we talk about with what I call the turnkey properties and a turnkey service, I think what I talked about before, one of the biggest, I guess, mistakes, and we probably did it as well initially in the service, was getting properties that were unrenovated. Because then there was a delay, they had to be renovated, took months, and then blowout in costs and all that headache. What we've done with the service now is have it all done so they're already renovated, and Ben and Tyler and their team, they do all that work before, they put their money into it, they renovate it so you don't have to pay for that, and then you guys find a tenant, so they're always tenanted before you actually, is that true?
Right, yeah, that's right. We do all the renovations ourselves. And then, well, not me with a hammer, okay, our crews. We do all the renovations, we do the leasing. As soon as it's leased, we turn it over to our property management company that manages it for us until it's sold to a client. And then, of course, you have the choice to continue with that management company or do what you want. I would highly recommend that you stick with the management companies that we use because we've vetted them out. We've had to make changes. We've had to sort of line our management companies into how we want them to operate and things like that. So we certainly have good teams in place for our benefit and your benefit.
Yeah, I think that. Who thinks that's important, by the way? Because a lot of you are thinking, what about management property? How do you get all these contacts? If you had to go and do this yourself, you've got to find a title company, you've got to find a building inspector, you've got to find a property manager, you've got to find an accountant to set up your structures, you've got to find a US tax lawyer, you need to
insurance agents,
insurance,
yeah.
all the stuff that you have to go through. But if it's all done for you or presented there for you, it just makes it a hell of a lot easier. Let's look at a couple more very quickly. We're running out of time. Here's another house in Kansas, 53,000 net yield, would gross 19%, net 14.7. You like those sort of rental? This is like a decent sized house. Let's look at we'll just skip through some and just show you another one. This is Atlanta now, isn't it? This
yes,
one Atlanta.
Mm-hmm.
So 20th century member, like this, I just went in the last boot camp.
Right.
Yes, I mean this went like crazy, and I think it's why Australians love bricks. Is it true? You should have seen how many people wanted to get this property. And obviously it's cheap, it's $51,000, 18.8% gross yield. But the fact, I think it was because it was bricks. And how many Australians can you get more brick houses? Australians love bricks for some reason. In America, they don't have many brick houses, so they're hard to get.
Yeah.
So you probably found that amusing. You know?
It was kind of fun. You know, we deal with a lot of international buyers and a lot of Australians in particular, and the Australians love brick houses. You guys love brick houses. We find a brick house that fits our model, that fits our demographic of where we want to be in the city, and all of that stuff. Once it's gone through our process and we say, okay, yeah, this is a house we like. If it's brick, we're actually willing to pay a little more for it, just because we know it's like our brick houses. They're sold before they're even rehabbed and tenanted. I mean, they are. I mean, because people know, they say, okay, well, you guys, you're going to rehab it, tenant it, you're going to do all this. We have somebody that's in line waiting, that signed a contract that says, when this thing's tenanted and rehabbed, I'm closing immediately. Put me, I want this property already. So most of these brick houses, again, they go so fast. Again, they will be sold before they're even completed and ready to be sold. So.
Yeah. It's amazing, isn't it? We're talking $51,000 for a brick solid house. What else do we have here? Let's a couple more examples. Another one in Atlanta, $57,000, nearly 18% gross, 12.5% net. And I think is that the last one? Yep, it's pretty much the last one. That just gives you enough examples. We're a little bit out of time to go into too much of that, but obviously those who want to come to a boot camp, that's one of your options will be 3 days. We can go into a lot more detail. Or you can go on a 3-city tour. I'll tell you about that in a moment. What else? Do we have anything else? I think that covers most. I'm going to go through a couple of more things now, wrap up. Does anyone have any questions? Quickly, I'll take 1 or 2 questions for Ben. Does anyone have any questions?
US dollar or Australian dollar prices?
They're US prices, aren't they?
Yes.
Yeah, they're US dollar prices. So yeah, you factor that in. If the dollar go, $1.07, we are now, so that's actually even cheaper. So that's great. If our dollar goes high, I did do an article. I'll talk about that briefly. I did do an article. I predict the dollar to go as high as $1.30 within 2 years, but there'll be volatility in between. In the 3-day boot camp, or actually on the home study as well, I teach how, when the dollar's going up and down, what it does, how you handle your strategy with that. You can actually make a lot of money from it. Okay, so all those things have already been thought about, and how to respond to what happens, because you don't control what the dollar's going to do.
With the Buckeye model, what sort of person's living in it? Where do they work, and what sort of job have they got?
These are going to be families, typically. These are typically going to be families, young families or maturing families. Where they're going to work, I mean, that's sort of a hard thing to pinpoint. But typically they're going to be dual income type families where the mother and the father both work. Does that answer your question?
Yeah, one more question down the front. Fire away.
Just want to know if there's body corporate fees on the condos.
There are. We refer to them as homeowners association fees, or HOAs. And there are those fees associated. If you noticed in the condo when we saw that, you saw the dramatic difference between gross yield and net yield. It was 19 something, I think, dropped all the way down to 10. That's where we factor those homeowner association fees in there. So it does affect the net yield quite a bit, because that's an expense that we incur.
Yeah.
And are they older people buying the condos, or?
I'm sorry?
Older people live in the condos, or young people?
That one's all over the board. That one's all over the board. It really is.
Yep. So for some of you thinking, like, some properties you've seen there for $30,000, some 50, 89. So there's quite a variance of price range. So it doesn't matter what sort of budget you've got. You probably pretty much need at least 30 grand. But a lot of people, you can use your super money to do that, or your line of credit in Australia. As far as financing, we have been able to get what we do is obviously help people through the turnkey service start setting up your credit, institutional credit history. We have a relationship with Wells Fargo Bank, even high up with some of the executives in the bank. Their goal, so what you'll be doing is, if you wish to get US lending, bank lending, it's not possible unless you already are a US citizen or have had a US bank history set up. Some of you have been trading with Options Express and stuff for some time. That helps. But they're working closely with us because they've basically said when they open up US bank accounts for you guys, there's no money in that really for opening up a bank account. They make money from lending you. And they're working towards us within 18, 24 months where they will ideally be able to lend Australians money. Now, we're working to get it sooner. They've made it now possible for Canadians because there's been such a demand for Canadians. They'll lend money to Canadians. Australians are the next ones. I said, if you lend money to Canadians, you should lend money to us. Just don't lend it to the Kiwis. You'll be right, okay? So they are planning on working on that because they're realising that Australians are a pretty safe bet. Australia's become more predominant with its economy going so well, our high dollar, so we are getting more international recognition. But 18 to 24 months where they will potentially refinance you if you want, but we're talking at US bank interest rates, which is 4, 5, 6% type stuff. Can you imagine that? As far as short-term financing now in the marketplace, we've had it for most of this year, but because it's through private lending, US private lending, what's available 1 month can all be used up and not available the next month. So for the last month, the last people in the last tour, they weren't able to get it there and then, but we took 3 guinea pigs and they're applying for it right now with another provider. And I have 2 other potential providers. One provider said to us that as long as you own 1 US property outright, they'll be able to get you finance for the second and third one using your first one as collateral. So that's something that we're working on. So US financing, hard money financing, how much does it cost? Generally you're looking at about probably 12% upwards. Okay, but you'd be taking that out for say maybe 18 months, 2 years and then refinance with a US bank. So what we do is we start your relationship with a US bank now. So you've got that underway, so you're not building up a credit score, you're building up an institutional credit history with that bank. It's only that bank that you'll have the relationship with. Another bank, it doesn't count, and they will do that, because that's their goal. So we've done a lot of work in getting this set up. When we're in Phoenix, for the tour, Wells Fargo opened their major downtown branch office, one of the biggest offices in Arizona, just for 21st Century members on the Saturday. Okay, they opened up to open up your bank accounts. They did that just for us because they see the long-term relationship in this. Okay, imagine 50 investors come from the US to Melbourne, and would the Commonwealth Bank opening up their head office, especially for 50 American investors, and have all their staff there to open up your bank account. You just wouldn't get that. In the US, at Phoenix, we had the mayor of Phoenix come and speak to our group and meet with us. He put us up in his mayor box at the NBA for myself and some of my partners. So, I mean, they really look after us. Now, the mayor of Phoenix, Arizona, like Phoenix itself, the greatest city of Phoenix, the economy is bigger than Malaysia, okay? It's bigger than Argentina, just that economy. That's how big it is. And the mayor who oversees that was willing to come and talk to us. So, they're very proactive business-wise. So finance, putting asterisk, we cannot guarantee a US finance immediately. We cannot guarantee that, okay? We are working hard. At times it has. Some of our 21st Century members have got it. It's been done. It comes and goes subject, because it's hard money lending. We can't always promise it. We're working on it. So next month we say, yep, here's a loan, you can get it. So just base your model on putting in cash. And if you get finance in the US, it's a bonus. But down the track, you can refinance, okay? In Australia, though, can you get line of credits in Australia? Yep. Goro spoke to you also other ways of coming up with cash on Friday nights. So speak to 21st Century Finance if you need to get money beforehand. The goal, if you're serious about this, should be about getting prepared. Okay, and I'll run through this very quickly before we go for a lunch break. So can we give Ben a huge hand? Thanks, Ben.
All right. Thank you.
Appreciate that.
Thank you.
So let me run through the PowerPoint. I'll tell you how you can become a US property member. If you want all this done, you say, Jamie, I don't have the time, I just want you to do it for me. Well, I'm not going to personally do it, but we have a whole US property team in Australia and the US, and all the contacts they've put together to do it for you. Or if you say, Jamie, I want to still do it myself, but I need more education, I'll tell you about the boot camp and the 3-city tour in Vegas if you want to come and party in Vegas at the end of it. Okay, so team, can we quickly hand out these forms? I'll run through it, and the prices, etc. For the membership service. Now, who's PD Gold member? There's a few PD Gold members in the room. You'll get some special discounts, etc. On top of this, speak to the team about that. We're handing out those forms. I think I've got a copy here. I'll just run through it. I don't have time to go through the checklist. We'll cover that in the 3-day, but you have a copy of it there, I believe, or they're going to hand it out to you now. what I'm going to run through is to become a US property member. The 3-day boot camp will go through all the structures. I don't have time to tell you about how you set up your structures, tax laws and stuff right now. That'll be covered in the 3-day boot camp, okay? Or, if you don't want to wait for the 3-day boot camp, when you become a US property member, you will get the 7-day home study of the boot camp that was filmed 3 weeks ago. With all that, you will get that shipped out to you in about 3 to 4 weeks. It's being edited as we speak. And it will be run out and shipped out at the end of June. So if you don't want to wait and just want to be a member, learn, and plus have it all done for you, you'll be able to do that, okay? So benefits up on the screen, if we can just put this on the screen quickly. So obviously, if you become a US property member, the goal is obviously you'll be accessing properties that are already renovated, tenants in place, 16, 25% type rental yields. Properties from as little as $28,000 is probably the lower end. You'll already be set up with a team of people that will do all this for you, building inspectors, title companies, legal advisors, property managers, etc. For you to spend the time in the US to accumulate the best people in that area, you're going to spend a lot of money to do that. With this, you won't have to, it's all done for you. As a US property member, we will set up your US bank account for you. That's where your rental income will go into, as well as building up your institutional credit history so you can refinance 18, 24 months, asterisk. No guarantee of that, but that's what Wells Fargo is working on. So having this done for you, it solves a lot of headache, because to open up bank accounts in the US otherwise, it's not easy. It just saves a lot of time. So that's done for you. Other things that you get: property management, record keeping, that's all handled for you. You also access to 21st century accountants they'll also understand the US side, so you can, if you don't want to, you can use them and Warren, etc., and they can do both sides of the equation for you. So that's all been sorted now. That makes it a lot easier, so you can just deal with our Australian accountants at 21st century accounting, and they can take care of the things for you. Structuring your property investments, we'll teach you all about that. How to use your super money to purchase, finance Australian options, etc. And there is some unsecured funds in Australia. Goro can help you with that. There's different levels of property membership. Do you have a form on this? Did they hand out the form? All the forms handed out? Okay, so we have it here. Let me walk this through with you. We've been doing this now for probably 6 months, but the structure has been changed. I recently bought out a company that services properties, internet-based model for Australian investors, to bring it into our team, because we had to go through the bugs in the system. We did tell our members that went through from January to May tours this year that the system's being developed, so we did have some bugs. We learned some lessons. It wasn't perfect. The bugs mainly were, don't buy unrenovated, untenanted properties. It's a headache. So we said, no, we're not going to do that anymore, just from a logistical viewpoint. Let's get them renovated. Let's get the tenants in place first. So it's just done for you. That was one of the lessons that we learnt. So the people in the May tour, that's what they got access to a few weeks ago. And the system's been continually improving. We brought in new suppliers as well, a choice of suppliers. We're diversified into markets as well. We used to only do Phoenix, but we want you also getting the cash flow, higher cash flows, diversifying Kansas and Atlanta, so we broaden the markets for you. So the service has come a long way. So level 1 access, so if you become a US property member, you get the US home study shipped to you, so you don't have to go to a boot camp. You can watch it at home. That's part of your package. All the other benefits, it's $4,995. That includes you at that level, includes you getting one property, so it's like paying an advocacy fee, but you also get the education and the services, okay? If you want to buy more than one property, you would consider the other levels. Level 2, the membership's the same as just $1,000 extra. That gets you the advocacy fee for 2 properties. Level 3 is obviously 3 properties, keeping it really simple. So you can pay a higher membership fee, you get all the benefits of the home study, plus you get 3 properties sourced for you, okay, in that fee. And you can be, which I'd recommend if you're serious about this, do this level. Level 4 is an unlimited membership. Unlimited membership means you can source as many properties in the next 3 years for no extra. It's part of your service. Generally, in the US, if you use any company, they'll charge you an advocacy fee, $3,000, $4,000, $5,000 per property. With this, it's an unlimited membership, $9,995, and it's unlimited amount of property. So you pay a one-off fee, all the services, the home study, as many properties as you want, you don't pay any more fees, okay? That's the fee that you pay for that. Plus, unlimited members get the additional bonuses. The 3-day boot camp held in Australia coming up in Melbourne, that's a $5,000 program. For you unlimited members, that's free, okay? 3-city tour in September is a $3,000 tour. For unlimited members, that's free. That's included in there for you. And you can come back to 3-day boot camps as many times as you want. Does that make sense? So as a package, also you can do that as payment plans. You can see you can pay that over. Well, actually, they haven't put the price there. It's on your form. Ignore that price there. On the form, the price is you can pay it at $7.95 a month over 12 months, that unlimited membership. So I would recommend, if you're serious about this, do the unlimited membership. It's a much more better valued proposition. Otherwise, you can simply learn to do it yourself. You can go to the boot camp coming up. These dates, you have a second order form there that looks like this, US boot camp. If you want to just do the boot camp or just do the 3-city tour, you can do that separately. Okay, or as I said, become a US Property Unlimited member, and all these are included. You can do the whole lot. Okay, so this 3-day boot camp is coming up. I'll be speaking at it as well. We're bringing in a host of other speakers. 12th to 14th of August, it will be in Melbourne. You're going to learn a whole heap of stuff. You can read about that later. If you're a 21st Century paid member, it's $3,995 to do that. All free if you're an unlimited property member. If you're a non-member, it's $4,995, and you also get the 21st Century Home Study at that. US 3-city tour, if you want to come on the US 3-city tour, this is being held in September, the first one. Okay, so if you look at that, that will be taking you to those 3 cities we talked about. It will not be like those who've been on a previous tour where it's education. This will be you're going there, you're prepared, you're ready to buy properties. So you're going to see properties in each of the cities, and you'll be able to actually buy the ones that you want, okay? So it's not so much education. You'll already have the education. You already have your bank accounts open up. You have your self-managed super fund ready. You're ready, so you see an opportunity, you can just take advantage of it. Make sense? Some of you may have already bought property, want to go on the tour, to be able to also see the property you've bought as well. So you can do it that way too. You have time to go and check out your property if you already bought some in those cities, and then when you're on the tour, you can maybe buy more and check out your properties, okay? But at least you're traveling as a group if you want to go to the States, as opposed to having to go by yourself, and you get access to all the experts there, and you'll continually be educated while you're there, but it's not seminar room content, it's actually out on the road looking at the properties. Make sense? You can do this event for I think it's $19.95 as a 21st Century member, or $2,995. What you have to pay is your airfares and accommodation. That's your tour and your content and your tuition, etc. The bus tours to all the properties. You'd need to factor in. You have to pay for your airfares and accommodation to the States for that. Okay. The last night will be held in Las Vegas as a farewell party night. Make sense? Okay. So that's how it works. To recap. If you're a US property member, it can be all done for you. You don't need to go to the boot camp. You don't need to go to the US. You can save that and just have it done for you. Or you might want to do everything. And if you want to do everything, become an unlimited member, because it's all inclusive, the boot camp and the city tour. Does that make sense to everyone? So you're clear on that. Any final questions?
Just the US dollar and the hedging and all that sort of stuff.
Yep. I don't have time now because I'm like about half an hour over. It's on the US home study. I covered that. So if you're a US member, you'll get that shipped out to you in 3 or 4 weeks, or we'll definitely cover it in detail at the boot camp, etc. So you will get that if you become a US member. You'll also get a free tax report. See the team up the back. They'll give you is that true? You're going to give everyone a free tax report? If you become a member, okay? They'll give you a free tax report for Australians and Kiwis of investing in the US.
Welcome, ladies and gentlemen. I'm going to tell you about probably the most incredible opportunity that is available right now on the planet. And I don't mean this with any exaggeration, what I'm about to show you is something that is absolutely a game changer for you and for me and for everyone in this room. So I really want to acknowledge you for actually being here to listen to what I'm about to show you. You've actually all been given some articles, and these articles are from the front one is from today's paper about Australians going to the US and taking advantage of what's going on. Behind there is an article from the Financial Review, which is from the last weekend, that goes into even more detail. All right? So what I want to show you is there's...
Sure. My name is Luke Camilleri. I'm 29 years old. I am in banking. I've been a mortgage broker or in the mortgage broking business for just under 10 years. Well, I'd actually been researching for 6 months even before I met Kevin, so I sort of had an idea that the returns were going to be good. One of the things I was really, really excited about was the quality of property over in Phoenix.
Now, you actually picked up a fourplex, correct?
Correct. We think the value was about 200,000. I think it sold 200,000 in 2006, so probably at the peak it probably would have been about 250, I would have thought.
And you paid how much for this property?
I paid 55, and then I'm putting another, say, 35 as a maximum in there. So we're looking at 90,000 as a maximum.
And what type of rent return?
We will definitely get, we think about 2.5 a month, 2,500 a month, so 30,000 a year. So, well, that's closer to 30% gross, isn't it? Really. The other property was a standard household dwelling with a pool. I picked it up for 57. Rent to a really nice family, so that'll be a good rental return. I think that will probably be closer to your 12%. The lawyer over there is fantastic, the rental manager as well. It's been really informative as well. That's the important thing to say. Once you're over there, you really get a feel, and it actually builds your confidence, because the process from start to finish has been informative, been thorough, transparent, everything that I wanted it to be. It's made it so easy for me to say, hey, let's go ahead and get moving.
There is literally starting to be an avalanche, a stampede of Australians going to the US. Why? Because in the US, you can get access to properties at incredible prices. Now, some of you have heard about this, but let me give you an example. What if you could buy for 25,000 Aussie dollars a property in the US that gave you a 25% rental return? Who would just think that's incredible? Right? That's just unbelievable. In fact, I'm going to have to ask you something tonight. You need to change your mindset, because I'm going to share with you some things that just, from an Australian mindset, do not make any sense at all. Literally won't make any sense. You won't understand. Like, you could say, how the heck is that even possible? All right? So what we're going to cover tonight is I'm going to talk to you about these 4 things. The history of the US property market, a strategy specifically to invest in Phoenix, and I'm going to explain to you why Phoenix is the choice. I'm then going to talk to you about our partners over there, and it's called Total Property Solutions. And then I'm going to talk to you about investing in the US market via 21st Century Property Direct, using our property system for the US. So, a little bit about the history of the US property market. This is what United States property prices have been doing. Can you see a particular trend there? It's gone up really sort of fast, but then it's dropped quite substantially. Can you see that? That's US prices, adjusted for inflation and normal house prices. This is what Phoenix has done. In fact, Phoenix has dropped further than the trend for all of US. Now, some people say, well, I'd love to buy properties in Texas, because I hear Texas is pretty good. Well, let me tell you the problem with Texas in comparison to Phoenix. Texas property prices haven't grown much. They've been very stable. They've trended upwards, but they haven't grown really fast. And consequently, they also haven't dropped very far. Now, as an investor, do you want a little opportunity, or do you want a lot of opportunity? A lot. Which one? Come on, little or a lot? A lot. A lot. Well, in the case of Phoenix, can you see that from the top to the bottom, there is a lot of difference? These are the sort of places we are looking for. But you could easily make the mistake of looking for any place like that in the US and be caught in places where literally the businesses that used to be there have used the GFC to shut down their business completely and move some divisions away to other cities, never to return. So some of the jobs in some parts of the US cities have been lost and will never return to those cities. Do you think that's an important economic consideration? Yes or no? Yes. Of course it is. So look what's been happening. There's been a surge of toxic mortgages from mid-2000 to mid-2007. You can see all the different colours there, the subprimes, etc., of what's been going on. These are some of the house prices. These are some of the specific cities. And you can see that there's been quite a number of cities that have had these huge bumps. The problem is that we have many different criteria as what we look for. And the number one criteria we look for is there's been a big upsurge, big downfall, and there's been a strong, consistent, resilient rental market. To put some numbers around this, let me show you. You have some places in the US where properties were, and specifically in Phoenix, if I can just go to the flip charts, were $250,000. And they have dropped to maybe $50,000. In some cases, $70,000. In some cases, even more than that. So that represents a drop of up to 75%. When was the last time you purchased anything that was a 75% drop? And here's the miracle part about it. The rentals haven't dropped by much. So even though they used to be getting, 3 to 5% rentals, their rental dollar figure hasn't dropped much, but because the price has, it means the percent yield has jumped to 10, 15, 25%. Who understands why? Because the base price has dropped so much. That's the miracle of what's going on there right now. Now, do you know in the US, it is in most places cheaper to own than it is to rent? By far. But you see, people in the US can't get loans. Many people have had their houses repossessed or their FICO scores weren't that high, so there's no way they're going to get a chance to be able to buy, and they are forced to rent. Who understands that? The other thing that's happened is because they've lost their homes, they have to rent, but many of them are moving to where there are jobs. When you move to a new location where there are jobs, are you going to buy immediately? Even if you can afford to buy, will you buy immediately? Don't you want to get the lay of the land, go past probation, make sure that the job is secure and what you want, and then you start looking for a permanent residence, correct? So this is why even people are choosing to rent until they actually find their feet and they're really certain again, okay? Now, does this give you an idea of the rate of foreclosure, right? It is going through the roof, right? Consistently rising. Now, just to put a number on this, the current number of houses that are currently in default in the US is about 7 million. Do you know that represents, if you added up probably every house in major cities such as Sydney, Melbourne, Brisbane, probably Adelaide and Perth as well, that's how many houses are in default at the same time. You can't get your head around this. See, Australia's population is about 21 million. Over there they have over 300 million. You can't understand, your brain can't function to say, what, every house in Australia in a major capital city is in default. We can't process like that. But that's the equivalent number that they have in default right now. This is how big the problem or the opportunity, depending how you want to look at it, is. Is that vast or what? All right, they have approximately 300,000 new houses per month go into default. We're only scratching the surface with how many properties that our members want to actually buy. 300,000 houses a month are in default. All right? Look, there's plenty of graphs to keep showing what's going on. But at the moment in the US, it's not just a garage sale, it is a fire sale. Who likes the sound of a fire sale where you can take advantage of that? Anyone? Oh, come on. Who wants to make some money? Show me. All right? So in the US, what's going on is this. We have partnered with a team of people over there. We have done comprehensive due diligence before we did all the partnerships over there to see who would meet our requirements. Let me tell you, the people that we have actually partnered with in these selected areas have been doing this for a long time. In fact, the main group we're working with, they have been doing this for over 10 years. They are what's called a super wholesaler. A what? Super wholesalers usually only deal with wholesalers who then deal with distributors and real estate agents, right? All the middlemen that often are retail facing, all right? They also sometimes deal with large institutions. These people buy between 300 to 500 properties a week in cash. Are you at that level? We're not at that level. These people, you want to be at that level, right? But these people, they do quick turnover. properties only stay on their books for like a couple of weeks or a month at a time. That's it. Guess who they sell to? Other wholesalers and other little middlemen. But they won't deal with you unless you're buying 50 to 100 at a time. They're just not interested. They'll pass you on to people much further down the pecking order. What do you think happens to the selection much further down the pecking order? Do you get the best ones if you're much further down the pecking order? And what do you think happens to the price much further down the pecking order when everyone adds their margin? You're paying much, much more. Who understands? All right? So, we've created these strategic alliances with these companies that have been doing it for over 10 years. In fact, when this company started doing this in the US, foreclosures represented less than 0.1% of the entire property market. And then and so they built their relationships on that. They specialised in that niche. And then along came the GFC, and they were in a better position than anyone else to take advantage. So they already had the systems, the connections, and the processes in place, and the people. They just ramped up their business. Who understands? All right? So they grew very rapidly because of this, because they could actually deliver these results. And what I mean by results is some of you may not understand. In Australia, when a property goes into mortgagee possession, the bank has the right to take it, and then they get a valuation, they sell it at auction. In the US, there is no such requirement. The bank just takes it and they sell it. They can sell it to whoever they choose to. It's theirs to sell. Is that a difference? It's a huge difference. So many of these properties are sold at auctions on county court steps. But now there's so many of them, or inclement weather, they actually do them indoors in one of the offices, right? When you go to some of these places, unless you can prove that you're either a US citizen or a green card holder, and or you can buy a certain number of properties with cash immediately, you probably won't even get in the door. Does that make sense? You just can't even get in the door. And they have them in every county all over the place. Imagine how much money it would have cost you to be on the ground for 12 months, researching the market, have a team there with you, attend all these different county auctions. What would that have cost you? Because that's what we've spent. Why? For our members. Who are our members? Us, including me, because we want an incredible system to help our members get incredible results over there. What we're planning to do is a US due diligence tour. Picture this. Imagine being side by side with me and all of the Property Direct team. And I mean all of them, because all of us are going there in January. We want to clean up. We want to go berserk. We each want to buy 20 properties, right? Who wants to buy 20 properties with us, right? We want to go over there. We want to buy whole streets or suburbs together. We're actually going to be on the bus. We're going to be going around all of Phoenix. We're actually going to be looking at all the different areas, the different types of properties. We're also going to get some of the best people teaching us. We're going to get a company. Who's heard of Philip Fox? Anyone heard of Philip Fox? They're the #3 law firm in the world in terms of size, right? They belong to a big conglomerate, and it's their parent company. Those people will come along and explain to us everything about the right structures in the US, as well as the dual tax treaties and the best way to repatriate money and vice versa. So we've got the right people in the US, but we also have a group over here. They're based in Melbourne who have already been helping Australians do this already. They'll be teaching us. They're accountants, they're financial planners, they're solicitors. All of these people will be on your team teaching you everything you need to know. In fact, they will not be allowed to leave the room until every single question is answered, right? So do you think that would be very valuable? To be fully educated, then be on the road, looking at all the sites. In fact, one of the testimonials that I'd love to show you is a young gentleman called Luke. And Luke is a mortgage broker. He was 29, who's based in St Kilda. And he just bought, actually I can tell you the numbers. He just bought what's called a fourplex. A fourplex is 4 properties jammed together under one roofline. Right? He bought a fourplex for $55,000. 4 properties, 2 2-bedders, 1 3-bedder, and 1 1-bedder. $55,000. Now, he's going to do a renovation on it. He believes the renovation will cost him about $30,000 for all 4. That's about $85K. He's worked out his numbers based on the monthly amounts that he'll get on all 4 properties. He'll make $30K per annum. What do you think his return is per annum? Gross, it's over 30%. The properties that are higher density, lower land, same as in Australia, they get higher yields, right? But they have less potential growth in them, right? They're apartments or multi-unit sites. The houses, they usually grow more, but the yield is lower. Who understands that? All right? So it's the same concept, but the numbers are just crazy over in the US, right? He sold his Australian properties because he was doing negative gearing and not getting very far and really struggling, right? He went over the US, he's looked at lots of different cities, and he actually understands that one of the things that we can provide is access to not just the properties, but more importantly, he actually says in his interview, to a team. Because it's so important when you're looking at properties from far away to have the right team, the right accountants, the right solicitors, all of these sorts of things. To give you an idea why a team is so important, you can actually go to the US right now, and if you applied for an ITIN number, which is like a tax file number, it could take you 6 to 12 weeks. Then you get your bank account. It takes a long time. We, through our team, can get it done in 48 hours. Now, is there a benefit to that? You bet there is. Because if you can have that set up before you have the property in there, then a whole lot of your other expenses can be claimed through that. I'm not going to go into too much detail, but some of you know what I'm talking about, right? Rather than setting it up afterwards. There could be a huge tax benefit in setting it up in the right order. Let's just leave it at that. So, who would love to look at properties that have dropped by 50 to 75%? Be shoulder to shoulder with us looking at those properties. Who'd want to be on that tour? Right? Imagine spending 5 to 7 days driving around, having all your questions answered, getting educated, and we're actually going to get the mayor of Phoenix to come along. We're also going to get the head of the economic development group of Phoenix to come along to tell us and show us who are they bringing, who are they poaching from other cities to bring into Phoenix. Now, just so that you know, Phoenix is a very safe city. It's got a lot of education there. It's got a lot of families there. It's much safer than somewhere like a Los Angeles. In Los Angeles, there's places at night you just would not go, right? There's streets and streets of them. In Phoenix, there's probably a couple of streets that you feel a bit sort of cautious going to, but that's it, right? Phoenix is much, much safer because of the demographic. It is also the home of 7 out of the top 100 Forbes companies. Intel is there as well. Has anyone heard of Intel? Do you think Intel might be producing some more stuff in the future? In this area, Phoenix has a huge amount of sunlight. The US is pushing green technologies. Guess where they're going to be actually doing a lot of the research? At the universities and places where the sun shines a lot. It shines a lot here. In fact, Phoenix has one of the largest universities in all of the US. Arizona State is one of the largest ones there. In fact, one of our colleagues was over there and they were driving along and he said, "Oh, when will we get to the university?" He goes, "We've been driving through it for the last 10 minutes. It is that big. 68,000 people attend the university. Like, as I said to you, we can't understand the numbers. They are so much bigger than the numbers we have here. Does that make sense? All right, so on this tour is a week-long tour with me, with Conrad, our whole team, with all of our US team and our US liaison. We have got them to set up an Australian and American team here in Australia. Same time zone. They're based in Melbourne, in South Melbourne specifically, to answer any questions. They have a complementary team in the US, right, that look after all of us when we go over as well. Because they have a belief that once you actually understand the lay of the land, once you've been around, you may not need to go back every single week or month or quarter. This young guy, Luke, he now wants to buy a property there, similar to this. He wants to buy one there every quarter. Do you think he needs to go back every quarter? No. In fact, the other property he bought on the last tour was a $50,000 property as well, but it had a brand new swimming pool which was worth $20,000. Who thinks that's really good value then? Right? Now, he won't get such a high return. He won't make a 30% return, but he believes he'll make probably a 12 to 15% return. Would that still be okay? Yes or no? All right? So, who would love to join us on a $5,000 tour? If we took you on the bus, if we introduced you our contacts and you got first pick of some of these properties, who'd want to do that? All right? Well, I'll tell you about qualification in a moment. All right? US tax laws. We've worked closely with some of the specialists over there and here to work out what's best for you, because if you went to an ordinary tax specialist in the US, they would say to you, well, this is the best structure that we know of. Yes, that's true for US-based citizens. not necessarily for Australians. This is why we've got the right people in Australia and the US who talk to each other. Who thinks that would be valuable? Right? Because you may not know this, but you might be able to quarantine some of your money there, tell the ATO and say it's over there, it's quarantined. Under the dual tax treaty, that might be perfectly acceptable. Because tax rates in the US are, guess what? They're lower than they are here. Who likes to pay less tax? Anyone? All right. Do you know in the US, in Australia, if you went searching for a property, that's not a tax deduction. To visit an existing property, it is. But under US tax laws, it is tax deductible. So your company over there could send you literally all over the world for the rest of your life investigating properties, whether you buy or not. Who likes the sound of that? You see, this is why it's important to have the right structure and the right people advising you, because you could design the life you choose and have the tax office pay for it. Who likes the sound of that? Anyone? But you wouldn't do anything just for the tax reason, of course. You want to make the money. You want to make the capital growth. You want to make the cash flow return, correct? But it's nice to have those extras thrown in. Now, in Australia, what we do is we have a very specific 52 points of criteria for every property that we look at. Over there, they have a very detailed checklist as well, but theirs is different to ours because different things happen there than they happen here. Similar, but it's different. So what they'll do is they'll show you and teach you all that due diligence. In fact, their team is so big, whenever what's called a tape of properties, which is actually a list of properties, goes up for foreclosure, they actually send a whole team of people, 15 people, out on the road. They go and inspect every single property and upload that information so the person who's going to be bidding knows which properties are good, which ones are no good, right? Because it's not just any property. Because you have to then bid on it. You win it, you have often 24 to 48 hours to come up with all the cash immediately. The reason the banks work closely with our team members over there and our partners is because they've got the cash and they buy from the banks literally 300 to 500 properties a week. The banks are very happy dealing with them. They have a very close working relationship because they solve the bank's headaches. Who understands that? The banks want to purge themselves right now of toxic mortgages and toxic property deals, right? And they want to start afresh. What's going to happen in the US is they are completely redoing the banking and lending laws. Do you know about this? Once they do that, lending will go through the roof. And that's what's on the front page of this article. It actually says, once Americans can lend again, they will buy homes in droves. That's what will actually happen. You understand that will happen. When they start buying in droves, what will happen to the price of properties? They'll go up real fast, okay? So, through our partners over there, our partners are willing to do a whole lot of things for our members. Look at these. They are willing to do property selection. Based on the same criteria, they will make sure that we get the best deals. They will also help us get finance. There's a test for this. Are you willing to do the test? Put your hand out. Everyone take out your hand. All right? Face it towards you. Palms towards you. Hold it close to your face. Do you feel any breath? You qualify. We are guaranteed to get, listen to this, guaranteed to get lending for our members. Do you know how significant that is? US people can't even get lending. So our members will get up to 75% LVR loans. Do you know what that means? Instead of buying with your money one property, instead of buying one of these with cash, what if you could buy 4? What if you could buy 4? Does that give you potentially 4 times the upside for when the market returns? Yes or no? That's it. The interest rate could vary from anywhere from 3.99 up to 12%. But even if you paid 12%, would you pay 12% for 5 or 6 months and then be able to refinance because now you've got a FICO score? Would you do that? Oh, well, great. Well, if you got one, you might qualify for some of the lowest rates. All right? Some people don't have a FICO score, but think about this. Even if you paid at a higher interest rate for 12 months and made the repayment every month, built up a score, and then you could refinance to a much lower rate, maybe 3 or 4 or 5%. Would that be okay? Because you could, do you know you could get loans for up to 30 years in the US at really low rates? That's insane. All right? So we can help you do that. Now, one of the things they also do is they do refurbishments and repairs. Now, they don't normally do this. This isn't normally part of their business because most of the stock they get, 90%, is they flip. To who? To wholesalers, to middlemen, to real estate agents, and to institutional buyers. But we have said that our members specifically want to hold properties long term. Why? Because they're not flippers, they're buyers and holders. Because Australians are very interested in making the cash flow number one. Number two, they're interested in the long-term buy and hold, the potential capital upside. Who would agree with that? Right? Why sell a good asset to someone else when you can get all the future capital growth? That's my question to you, right? Now, what they're willing to do is for our members is to actually build up their refurbishment team. They call them a rehab team. And I said, well, for us, rehab means you rehabilitate people, you renovate properties. For them, it's just, well, we rehabilitate houses. So, but anyway, they thought we were weird. I thought they were weird. Doesn't matter. What they're willing to do is do what are called rehabs up to a rental level. That means a new lick of paint and often new carpets, that's it. So they have a team that goes in, they do a clean, they do a repaint, recarpet, bang. But they're willing to do that for us on a wholesale basis. Now, do you understand that if you went over there and you did it yourself and employed people, you could be in violation of visa requirements. You could get thrown out and you might not be able to go back to the country. You understand that, right? So it's important to understand what you can and can't do. But they can do it for you. You can still get quotes from other groups, but they will do it fast, efficiently, and they'll do it at a wholesale price. You can use them or not use them. It's your call. As Property Direct, we're always there to help you as much as you want to be helped. Does that make sense? Remember, they are not willing to offer this to any of the other clients they have on their books as property managers, only to us. Why? Because of the bulk we have said that we can do with them, right? And they've seen how many people are on our database. This group has never done any sales or anything like this through seminars. They actually don't understand this, right? They just sell to wholesalers. That's all they do. They get a whole lot, they chunk it up, and they sell it to wholesalers. We have said, because our members love property, and because of the parity Aussie dollar, and because we can get them financed, that they will buy at the same volume level as a wholesaler. Who understands that? So for them, it's just another wholesaler. But what they like about it is because our members want to hang on to the properties, that they can actually do some more renos, add value, and they'll earn a small margin on that. But also on the property management side, they earn margin for a long time to come. Who understands that? Right? So they're very happy with that. They're willing to give it a shot. And they've said if it works well, they want to work with us on a broader basis. And that's very exciting to be the first company to deal with this joint venture with them on that basis. Now, some of the other things we can do is we can organise insurance, the solicitors, the building pest inspectors, the accountants, setting up the US bank accounts. All of these things we can actually negotiate and get set up for our members. Now, just to show you where Phoenix, Arizona is. Phoenix, Arizona is right there. It's about an hour's flight from LAX, not far from Las Vegas as well. That's what it looks like. It is a big city. Just to give you a perspective, it is the 5th biggest city in the US. We're not talking little backwater here. 5th biggest city, right? Now, in Arizona, we've identified Arizona as our primary market. We've looked at a whole lot of economic indicators. The main one is we pick cities that grew fast, drop substantially, but have a strong economic base and a very strong resilient rental market, because we know they will be some of the first to rebound. You can go to places like Detroit and Ohio and a few other places, and you can buy properties there that have gone up and fallen dramatically. But if half the population has left that area, never to return. If businesses have shut in Detroit, never to return. What do you think the economic future of that place is? Pretty bad. Who would agree with that? Okay? So, our partners allow you to actually buy properties, not just at the lower market price, because that's what it used to be, but the retail for this property could be, for instance, $70,000. And if you went through their lower tier sub-wholesalers and distributors, you might pay 70 grand, which would still be excellent value, agreed? But because you're getting it direct from the super wholesaler, they only make a small amount of money on each property, somewhere in the order of like $5,000 to $6,000, because why? They need the money to actually secure them, hang on to them. They need to often do a very small reno. They need to pay for their people going out. I don't mind them making a small amount of money, as long as I know that I'm buying at a really good price. These prices are literally below bank values and or below government valuations, right? So you're buying at an incredible price in the US market, but you're doing it in a way that's under a system that's actually very, very safe. So let me tell you more about that. In fact, in the US market, you can start investing through our partners from as little as $25,000. In fact, if you bought one of these at $50,000 and you managed to be able to get a 75% loan, how much do you actually put in? If you qualify for a 75% loan, how much do you put in if you bought a 50K property? $12,500. Do you know some people pay more in stamp duty and get nothing for it? Imagine getting a whole property for that that's positively cash flowed. Phoenix, Arizona. Our network allows people to get access to properties, as I said, 10 to 20% below current market valuations, and that is well below government and bank valuations at the time. Here are some of the key reasons. Look at these numbers. Low prices, 3 and 4 bedroom, fully refurbished houses. And when I mean refurbished, I don't mean like the Taj Mahal, like you want to sell to an owner-occupier. This is basic new lick of paint, cleaned, new carpet if required. All right? Maybe just steam clean. All right? $49,000. Through other systems, you would have to pay 100% cash for that. Through our system, you can do it with up to 75% LVR. For the same money, you could buy up to 4 times as many properties, have potentially 4 times the upside. That's the huge opportunity. Some of these prices are 75% below what they were just 2 to 3 years ago. And let me tell you, some of these properties are only 3 to 5 years old. I'm not talking a completely dilapidated wreck. I'm talking some of these are 3 to 5 years old. And some of them are 5 to 15 kilometres from the city. I'm not talking out in the middle of the desert. Talking 5 to 15 Ks. So these are pretty good properties by any standard. All right? So we predict there's going to be a huge capital appreciation. When the US market starts to move again, we believe they'll at least go back to where the prices used to be, and they'll continue eventually moving on. That will take some time. I believe that probably about 50% of this price will come back in about 2 years. Just 50% of its value. I believe just to its old value, it'll take 5 to 6 years. But if the property is paying for itself and giving you positive cash flow, is that going to hurt or is that going to be pleasurable? It's going to be good. You're going to be getting money. You can afford to hang on to it for 5 or 6 years, can't you? Because it's making you money. Who understands? Is that a much better way than a negatively geared property? You bet it is. All right? So mortgages, we guarantee through our partners, we've been guaranteed because of their finance contacts that all of our members will be able to get finance. Now, not everyone will get 75%, but even if you got 50 or 60%, would you be happy with that? Because instead of buying one, you could buy 2. Would that still be okay? One of the other things we've negotiated with them is we've said to them that our members want to buy through self-managed super funds. We have managed to get from them, simply because of our bulk. Other people just can't do this, full stop. We've been able to get from them the ability to get a CIS-compliant super loan. So you understand that super funds can buy properties and they can get loans. They have to be very specific loans, worded a very specific way. Do you understand that? And if it's not compliant, you're in big trouble. Right? It's too hard for people buying one-offs. No bank in the US would lend you money full stop, let alone for a super fund. They won't do it for you. We, through our bulk and our leverage and our relationship with them, have managed to negotiate that you can. Up to 50% LVR, get a loan through your self-managed super fund over there. Who thinks that's incredible? Right? That is just truly amazing, because that allows you to get twice as many properties literally in your self-managed super fund, or get in much earlier for much cheaper. Now, the rents in that area, ex-homeowners have turned to rental accommodation. I gave you all the reasons why. $850 to $1,000 a month. This means, in comparison to the Aussie market, where you'd be losing net about 5% a month, you're making 10 to 15%. That's a 15 to 20% difference in terms of cash flows. You understand? Instead of being negative, you're actually positive. For the same amount of outlay, instead of being negative, you're positive. All right? Why else? Cash flow is king. You need cash flow. Cash flow is like oxygen for an investor, right? It allows you to do so many more things, to buy more properties, to get involved with other things as well. All right? I'm going to share with you some of the things they've said about Arizona in reverse chronological order. It's the 4th best city in the United States for expansions and relocations. It is the best place for business and careers. It is the second best city in the nation for business expansions. It is the third best city for relocations in 2009. Maricopa County in 2009 population is estimated to be 4.2 million, about the size of Sydney. That's just one of the areas of Phoenix. It's not Phoenix. Do you understand how big this place is? Right? And it ranks fourth amongst the nation's counties and is it has greater population than 24 of the states in the US. Phoenix is the fifth largest city in the entire USA. All right? Since the early 90s, Arizona has experienced tremendous population and job growth and has grown 24% since 2000. The state has been among some of the top performers nationally in job creation for several decades. Do you think that's an important characteristic? Do you think people there are good at attracting businesses, which reinforce the local economy, which keep people busy and working and paying taxes, state, local and county? Yes or no? Yes. This is why it's a prosperous place. They have listen to this, they have an average age of 34. Why is that significant? What do people do when they're around 30s, early 30s? What do? They have babies. When people have babies, are babies expensive? Yes or no? So, guess where they'll be pumping all this money into for their children? Into the local economy. Who thinks that's a very important aspect of the economic cycle there? Right? So this is why it's so important. This is why if you went to places like Florida, where people have a median age in some parts there of 60, they're not going to be spending a lot and pumping money, and they're not going to be having babies, correct? This is why it's so important to understand these economic drivers and what they mean. All right? They're expecting 60% population growth there. Look, Phoenix, one of the other things that you don't understand about Phoenix is it's a major tourist hub. Now you think, why Phoenix? Has anyone heard of a place called the Grand Canyon? Yeah, we have a rock here big enough that can fill it. The Americans didn't think that was very funny, by the way. Uluru, right? But do a lot of people, do you think, go to the Grand Canyon on a regular basis? Americans love to travel within America, right? So there's a huge amount of people, of tourists, that go there each year. In 2008, Sky Harbor, which is their largest airport, serviced 40 million passengers. So about twice the population of Australia went through their airport one year. I'm telling you, you can't get your head around some of these numbers. They are this big. All right? Now, just to show you some numbers, this is Phoenix. Look at the median house price of what happened to property prices in Phoenix. They went up and they came down sharply. All right? They're the sort of places where opportunity lives. What lives there? Come on. Opportunity for you to make money. If you want to make money, you need to find places that go up and fall fast, because people there are still in fear. They're still scared and they can't get money from the banks. But do you think soon that the fear will go away? Do you think the money will start becoming available? Do you think people will rebuild their FICO scores? Guess what will happen to these property prices then? They'll go up a lot. This is why there is only a 6 to 12 month opportunity in Phoenix. Right? Property prices there have already started to edge their way up. There are places in the US that have fallen equally, but they're going to stay down for a long time. There are other places that already have these green shoots. And let me tell you, other people have started noticing that Canadians are the biggest group buying in Phoenix right now, right? Because they've got good credit and they can buy in the US very easily, no problem. Their banks will lend them money, right? There are some institutional investors that are targeting Phoenix as well. So I'm telling you, you want to make some money, you want to make some of this upside, you better start acting within the next 6 to 12 months. Otherwise, the game will be over. This is a complete game changer. You can't get access to property deals in Australia where you can get this level of growth, a 500% return in growth in the next couple of years. It's just impossible. You can't do that sort of thing in Australia. This is a unique opportunity that will not last. Now, even in bad times, recession times, the population of Phoenix and its population growth did not go negative. A lot of other places went negative. Phoenix, even in the worst times, it still grew, but grew at a slower rate. Why? Because of the university. How long do people go to universities for? 3 to 5 years, correct? And a lot of people in the US have realised that they need to massively reskill and fast. Where do people go to reskill? Universities. And in many cases they get grants from the government, right? And they have to repay these student loans over a longer period of time. But they get those loans that allows them to go to these universities and pay for their lifestyle there. So this place has got a very diverse economic base. We have education, we have tourism, we have a lot of other companies, the Forbes 100 companies that are there as well. Our partners there is a group called Total Property Solutions. Let me tell you a little bit about them. They understand the importance of offering really good US property deals to our members, right? So these properties, a lot of them, listen to this, are already tenanted. They will look after the refurbishments. They will make sure the refurbishments go to plan. They look good because they're the ones offering the guarantee. They need to know the refurbishment's done properly because otherwise they're trying to pay you rent when they can't get enough rent. So we've done what's called a risk reversal. We've put the risk back on them, so they're going to make sure the refurbishment's done quickly and it's done well enough to rent that property for 10 years. So is that peace of mind or what? Right? Also, they got value-added services. They got a whole team of accountants, solicitors, people they deal with on a regular basis. These people will make sure that you get your ITIN number, which is like your tax file number. They'll make sure you can set up your bank account. They'll put you in touch with all the right people that you need to make this smooth and easy for you. We've got the same people here in Australia as well who work with them. Property management. Do you know in some parts of the US, you could buy a property on the internet tomorrow? Do you know in some of those parts, there are no property managers. There is no one to look after your property. And in some other parts, the property managers are unregulated. It's not like Australia. If you want to actually have a real estate office in Australia, you get a real estate agent's license, right? Or a sub-agent's license. Whether you're in property management or sales, you need that license. Who understands? In the US, a lot of the real estate agents or realtors are just salespeople. They don't do rentals. Rentals are ad hoc. It's not regulated. So some places you go do not have rental people. Some of the places do have rental people will not go into the property you've just bought. Because unlike Australia, in the US you could literally have a beautiful property, across the road you could have a gang home. Right? You could literally across the road go 10 levels of demographic down. Doesn't happen in Australia. It's much more homogeneous and also it spreads out or changes much more slowly. In the US, you cross the street, you could be in a really bad neighbourhood. Does that make sense? So we had a situation where someone bought a property that we know of, right? It wasn't through us, but they bought it on the net and they didn't know why they couldn't get a property manager to help them. They couldn't get any rent because the gangbangers running meth coke labs were in the rest of the building. They were too scared to go in. So how would that work for you? Wouldn't work very well, would it? Okay? Some people that I know bought some cheap properties, but they didn't realise in the northern suburbs it's bitterly cold, and in those properties they ripped up all the floorboards and they made fires. Some other places, unless you actually insulate and look after the pipes, they freeze and they burst. Can you imagine replacing all the plumbing on a property? Do you think that would cost a bit? Yes or no? This is why a lot of people in the northern areas are moving to the southern areas because it's less maintenance, it's cheaper, but more importantly, the cost of oil, heating oil, has been going up dramatically. And when people don't have money, they don't have money to pay for this. They want to move to warmer, drier climates. Does that make sense? This is why these southern areas that are warmer, particularly if they're dry, are actually getting such a strong population shift to them. And because you've got employment there, they're not just moving there for the climate, they're moving there for the job opportunities. Who's understanding that? All right? Now, what we want is a system to make it entirely hassle-free, and that's what we've done by having the right team in place. No maintenance. They look after all of this. You give them, just like in Australia, pre-authorisation to this level. Anything above that, they'll call you. Now, what will also happen is you can still get independent quotes, but isn't it nice to have the opportunity for them to look after everything if you choose to? The mortgages, we've organised for all of our members to be able to get and qualify for mortgages. That's incredible. just about everyone else in Australia who's going there is having to pay cash. Our members can get 2 to 4 times as many properties with the same amount of cash, and that's amazing. And some of those with potentially FICO scores may qualify immediately for up to 75% and as low as 3.99% loans. All right, we are getting pricing and discounts based on super wholesaler levels. We're offering clients up to 75% discount off the previous highs of 2008, and that's still 10 to 20% below what current market is. You can't do this cheap or easy yourself. You just can't. You don't have the time or effort to drive around all the different counties, inspect all the properties. This is why you need a system. You need people on the ground. This is what we can do, and we're doing this for all of our members. After sales support, they have gone to the trouble of setting up an Australian-based office in South Melbourne. It's literally a couple of streets away from our head office. All right? They come in the office often. We talk about what we need to do, and they're very easy to talk to. They understand the US market and the Australian market. US bank account, once you've set up one and you've provided your equivalent of 100 points of ID, and they'll help you through that whole process, you can just set up more very easily on the telephone or via fax. Super easy. Australian accountant will help you understand the double tax treaty and all the different options you have to maximise your position within that. It's literally a turnkey model. They don't do this anywhere else in the world. We've set up a system with them that makes it super easy, and they want to work with us, make this work so they can do it again and again, and we will partner with them through other parts of the world, starting with Australia, then New Zealand, and then Asia as well. Okay? Now listen to this. They are using their own money to literally buy properties on behalf of our members who will come across in the January trip, right? So they have a large belief in us that our members are serious and want to buy, because they're going to be buying properties and holding them longer than what they normally do on behalf of our members, right? Because we've said to them that our members, they want to get into this market, they want to get some of the best deals. Would you like to see some of the deals? Would you like to see some of the numbers? Yes or no? Come on, you excited? Look at this. Look at this property. Purchased in February. Which year? Which year? 2010. This year. So how many months ago? About 9 months ago. $50,000 US. So that's a little bit less in Aussie dollars. Right? Take off about 1 or 2%. That's Aussie dollars. Look at this. It's a 3-bedroom, 2-bathroom. This is a practically new house. It's only a couple of years old. 50 grand. It previously sold in mid-2007 at $183,000. Probably went up to sort of mid-200s. You are getting a gross return of nearly 21% rental return. Who'd be happy with that? All right, look at this one. I like this one even more. Look at this. It's a 3-bedroom, 1.5 bathroom, sold in March which year? This year, March this year. This could have been a property you bought, $23,000. Our initial people had to pay cash. We hadn't had the loan set up. $23,000, would you still be okay paying 23 grand? And getting a 35% gross return. Last time it sold was at $70,000 in late 2008, but it was $135,000 in 2004. Would that be an okay deal, yes or no? What about this one? 3-bedder, 1 bathroom, $39,000. Its rental return is 23%. Look at this one. This one's also sold, was 19% rental return. It was $150,000. It was a 4-plex. This one was much newer than the one this other guy bought. Didn't need any renovation, and it last sold for $220,000 in December 2005. Look at this one. I don't like, it's got arches, but you know what? It's not what I like. I got to not get emotional. I don't like the Californian sort of arches. It's about the numbers. What's it about? The numbers. Look at these numbers. Gross rental return, 18%. Purchase price, $45,000. Last resale, March 2006, $170,000. So this probably went up to mid-200,000s as well. Look at this one. 20% return. This is like a townhouse. $46,000, last sold for $143,000 in December 2000.